Live from Studio 2 at Bloomberg headquarters in New York. This is the countdown to the close. I'm Romaine Bostick alongside Katie Greifeld, 3 weeks removed, of course, from the last Fed meeting where Jay Powell made it clear what he wanted. The dot plots made it clear what it wanted. And a readout from those meetings that drops right now. Michael McKee is standing by.
At the time of their meeting, the minutes show Fed officials felt that interest rates were now restrictive and, quote, broadly restraining the economy as intended. Caution would be warranted in future rate decisions. But there was disagreement over whether rates were high enough to bring inflation down to their 2% target. While the vote to leave rates unchanged in a range of 5.25% to 5.5% was unanimous, other non-voting members of the policy committee apparently disagreed. Almost all participants judged it appropriate to maintain the target rate, the minutes say. A majority of the participants judged that one more increase in the target federal funds rate at a future meeting would likely be appropriate, while some judged it likely no further increases would be warranted. Supply and demand were coming into better balance, the minutes say, particularly the labor market. Pay increases were slowing, but inflation still remained too high, and, quote, a vast majority of participants continued to judge the future path of the economy as highly uncertain. Credit conditions were tightening, energy prices rising, the Chinese economy was slowing, and the U.S. faced a threat of a government shutdown. There were also concerns about the impact of the auto workers' strike and about commercial real estate. Still, all participants agreed that policy should remain restrictive for some time, and several argued the Fed should shift its communications from a focus on how high to raise rates to how long to hold them there. As for the balance sheet, the feeling was they could continue their passive rundown for some time, even after they begin lowering rates. Guys?
Not much of a reaction in markets, Mike. You can see 10-year yields still about 5 basis points lower. The S&P 500 pretty much unchanged since before the minutes came out. And when you look through the headlines, this one sticks out. Proceed carefully. It feels like that phrase has appeared many times, and we're seeing it again in these minutes. Should we take that as to mean that this Fed is going to stay on hold for some time here?
No, I wouldn't take that to mean that. I think it means that there's kind of a higher bar for a change at this point. They want to make sure that they aren't doing something that's against the economic best interests, given that they are in restrictive territory right now. We'll see what happens with CPI tomorrow, PCE at the end of the month. But as long as there are no surprises, they probably are still looking at not raising rates on November 1st. But that's proceeding carefully.
Michael McKee down at the Fed meeting, a readout here of the minutes from that last meeting in September, 3 weeks ago. Of course, 3 weeks ahead, we get another big meeting and a lot of questions right now about that more than 5 percentage points of rate hikes that we've already gotten into the system, whether there's more to come and whether the lagged effects have actually been seen. Victoria Fernandez joining us right now to help us kick us off to the close, Chief Market Strategist over at Crossmark Global Investments. Victoria, always great to talk to you. Let's start off with those rate hikes. I should say that basket of rate hikes that we've gotten. If you do believe that we are at the end of this rate tightening cycle, do you think that the full effects of that 5.25 percentage points of rate hikes that we've gotten has been fully felt already?
Not at all, Romaine. I think we have quite a significant amount of time ahead of us in order to feel the complete effects of 525 basis points. Look, it takes typically 18 to 24 months for it to fully work its way through the economy. And that's when we had a economy like we did a few years ago, where there was a lot more adjustable rate mortgages, a lot more adjustable rates in regards to auto ownership and different things like that. So affected us more quickly. Now it's going to take a longer time for that to work its way through, because we've greatly diminished the amount of adjustable rate loans that are out there, not just in the U.S., but compared to the rest of the world. So it's going to take some time. We've started to see it. Where I really want to be watching is when earnings kick in, the official kind of unofficial start of earnings on Friday with the banks. What is the guidance telling us? What are the margins telling us that we're seeing there? Are we finally starting to see it in the earnings? earnings? If we are, then it should start to flow through to the labor market pretty quickly.
Well, I am curious then as to how investors position themselves. Even if you don't believe we're headed towards a recession, you at least have to acknowledge some of the other sort of exogenous events here that have rattled the markets and to a certain extent the economy, whether it's what's going on in Washington, whether it's now the war in Israel, as well as a whole host of other unresolved issues out there here. How do you position in this environment with all of those things still looming?
Yeah, we don't think you should take a mild recession off the table at all. We think there is a probability that that can happen. So when you're positioning your portfolios, you don't want to just go to all cash. Although I will tell you, since October, the lows in October, we've had $1.1 trillion move into cash or to money markets. That's a huge amount, both on a dollar basis and a percentage basis that we've seen in the last 35 years following an equity low. So we have to anticipate that people are moving to cash. We, for our clients at Crossmark, are keeping them invested in the markets, but you've got to do it with some balance in your portfolio. Have some short-term treasury exposure in your portfolio. Get that 5% yield that you have there. Lock in a little bit more further out the curve in the fixed income if you need that consistent cash flow, but have some exposure to the equity market because we do think there's going to be continued volatility. You want to be able to capture the upside, but protect yourself some on the downside. You can use alternatives for that. You can use covered calls for that. We like picking up some of the areas that have come down a lot, like healthcare. So I think you just have to be very choosy right now and finding your place without trying to time the market perfectly and be all in or all out of the market at once.
Victoria, I want to pick up on what you said about the long end of the curve when you think about long-dated treasuries, because really even a week ago, very much the conversation was about how much supply was coming, how sort of the structural buyers in the treasury market had come out of that market. And now we're seeing obviously a big flight to quality there, a haven bid, if you will. How sustainable is that? Or do you see some of those other factors that we've been talking about for the past couple of weeks coming back into the price?
Yeah, well, obviously we had that big run up in yields. A lot of that, I think, was the market pricing out some of the rate cuts that they had anticipated the Fed would be making in 2024. Some of those came out. You still had some hawkish tones from the Fed, and so that was feeding rates to move higher. But now, you're right, we have a flight to quality, which has brought yields down. We have a Federal Reserve. I mean, look at the Federal Reserve speak we've heard this week so far. You have Bostick saying we're sufficiently restrictive. You've got others saying that we have to be extremely cautious. We just heard the words come out of the minutes. And you have a lot of short covering that's going on as well that's bringing down those yields. So I think go ahead and find some areas on that longer end of the curve. You're still looking at a 4.5% to 5% that you can get on some of these investment grade corporates, some of them even going up towards 6% on the 10 or 15-year part of the curve. If you have high quality names and you can lock in some cash flow for that period of time, I think you're sitting in a good position for a small allocation in your portfolio to reap the benefits of that. Even as yields come down, then you also get the added benefit of prices moving higher.
So, Victoria, a lot of opportunities in the bond market. Let's talk about equities a little bit more, because you brought up the fact that we are headed into earnings, the big banks kicking us off later in the week. It's interesting. If you take a look at what Wall Street is expected, the earnings revision momentum is actually back in positive territory, just barely. Does that seem right to you, or do you think some of that optimism is premature?
I will say it makes me a little nervous seeing some of these numbers. I mean, you look at probably your fourth quarter now in a row of negative earnings, but at a much smaller negative rate than what we've seen in the previous quarters. There's a lot of optimism going on here, and 12% earnings expectations for next year. That just seems really high to me, especially in a time like we've been talking about here, in a time when you've got a consumer that's probably slowing down their spending. You're going to have margins that are getting compressed. We're seeing input costs go up. Wages are higher. higher. There's all sorts of elements here that tell us we should start to see some pressure on margins and on earnings. And look, the equity market has really been supported by that multiple expansion. I'm not sure we're going to continue to be able to have that unless we see earnings do better. I think the question here is how good is good enough going to be for earnings season? Is just matching expectations okay? Do they need to have a really strong positive surprise? I think we have to be a little cautious going in here, and those expectations that are out there seem a little lofty to me.
Victoria, always great to talk to you. Victoria Fernandez there, Chief Market Strategist over at Crossmark Global Investments, helping us kick off to the close here on this Wednesday afternoon. Coming up, an update here on the Israeli-Hamas conflict. A rare emergency government formed by Benjamin Netanyahu as power to Gaza remains cut off. We'll have the latest on the war.
Plus, Exxon agrees to buy Pioneer for $60 billion in a move to dominate shale oil. We'll take a closer look at what it means for the energy sector.
And booming demand in the private credit markets. We're going to get some insights from Crescent Capital Group and some of the options and flexibilities that some of those players are taking right now in a higher for longer rate environment. All that and more coming up in a bit. This is Bloomberg. All right, Israel Prime Minister Benjamin Netanyahu forming a rare emergency government that includes some opposition members as it gears up for what most people assume are going to be retaliatory strikes after the incursion out of the Gaza by Hamas over the weekend. Sonam Vakil joining us right now, director of the Middle East and North Africa program at Chatham House, to talk a little bit more about what we know. And more importantly, Sonam, I think everybody kind of wants to know, with some of the rhetoric we've heard out of Israel saying that this retaliatory strikes or whatever sort of response that they make militarily going forward will, in effect, reshape the Middle East. And I'm curious as to your thoughts as to how exactly that's going to be done.
Thank you for having me. It's awfully hard to be predictive, particularly at such an early stage of a military operation. It's important for Israel that Netanyahu has brought on members of the opposition like Benny Gantz into a unity cabinet. This will help keep cohesion and reduce domestic tensions at a time of a security crisis for Israel. It seems that Israel is on the precipice of a ground invasion of Gaza, and this, of course, is going to unleash what already appears to be a massive humanitarian crisis in Gaza that will impact Palestinians there, but, of course, will trickle over to the West Bank. So we have to consider the immediate effects. It's really hard to imagine what a new Middle East is going to look like. I can barely imagine what next week is going to look like. This attacks and then the outcome is really unpredictable right now.
Well, I am curious about the humanitarian side of this for those folks in Gaza. We're talking the civilians, of course, those not affiliated with Hamas. And I am curious as to where, if they are forced to go, where exactly would they go? Are there other Arab nations out there, other Middle Eastern nations that are willing to take in a large amount of potential refugees?
That's a really important point. In fact, the prime minister did tell Gazans to go. And the great irony is there is nowhere for them to go. Gaza is effectively an open-air prison. The borders are closed, and the crossing to Egypt is also closed. So that is essentially the problem. It will be we have to watch and see if the Egyptian government opens that border crossing. But if that doesn't happen, I'm really worried this is going to escalate, and ordinary people that are just caught up in this conflict are the ones that are going to bear the cost, as it is always.
And Sanam, I'm really curious to hear your perspective on Saudi Arabia, because prior to the events of the past weekend, of course, the Biden administration had been leading those diplomatic efforts to support an Israel-Saudi normalization agreement. When you think about what we've seen in the past week and what the next couple weeks and months could look like, is that normalization still possible?
I think these attacks and the war has really derailed the normalization process. I don't suspect that that process is completely off the table, but it delays the timeline that was being pushed by the Biden administration. And I argued that the timeline was a little ambitious already before this war and this conflict in Israel and Gaza. So I think it's going to be pushed further afield. You know, what is a really stark reminder is that the Palestinian issue is a critical one for Palestinians, but also for the region more broadly. And without properly bringing back the Palestinian issue to a negotiation process, this will be a constant conflict in the Middle East. And I think Saudi Arabia has woken up to that. And the new asks and the new demands on the table will have to provide some off-ramp, some process that brings Palestinians and Israelis together to address what is really an existential issue for both sides.
And Sanam, I'm looking through your notes, and you write that Saudi Arabia here has an opportunity to lead on Palestinian process. What exactly could that look like?
To be very honest, it is really early days. We do have to wait and see how the war unfolds. But I think that with war comes peace, and every conflict has led to more or less some kind of a peace process, ceasefire negotiations and the like. So we should be thinking about the peace. And I sort of implore Saudi Arabia, as well as other Gulf Arab countries, to think about what that peace process should look like. Yeah. I think that we need credible partners on the Palestinian side. The PLO under Mahmoud Abbas has not been seen to be a credible partner. There haven't been elections. There is a leadership crisis there, and that needs to be addressed. But at the same time, obviously, bringing together both sides and thinking about how to address Palestinian sovereignty would be ultimately the key component of Middle East stability, as well as Israeli and Palestinian stability. And so I think the region has an opportunity, and Saudi Arabia, who has a carrot here, has an incentive through normalization, could take the lead.
All right, Sanam, really appreciate your perspective. Our thanks to Sonam Vakil, Director of the Middle East and North Africa Program over at Chatham House. Now, coming up on the close, shares of Birkenstock slide in its widely anticipated trading debut. More on the moves next. This is The Close on Bloomberg.
All right, the new kid on the block here in the U.S. markets is Birkenstock. The company having its IPO yesterday at $46 a share, opening today at 41, and really hasn't gone much anywhere ever since. Bailey Lipschultz joining us right now, who covers the IPO market for us here at Bloomberg. And Bailey, I mean, overall, when you look at the IPO price of 46, I guess that is a successful IPO. When you look at the secondary trading, and I know it's only been an hour or so since we've had it here, what is that telling you?
Not a lot of optimism, not a lot of demand. The big thing, Romaine, is if you look at the cornerstone investors, about a third of the book potentially was spoken for. So you have a limited amount of shares out there available for trading, likely, and people who want to get in and out of this stock. And when you look at the indication pricing, that really trended lower from that IPO price of 46. When you open below the low end of your IPO range that you brought to market, it's not a sign, again, of initial excitement, but long story for a long company will be the days, weeks, and months ahead.
I actually have a size and scope for you guys. I'm taking a look at the Bloomberg News story. This is actually the worst opening for a listing of $1 billion or more in New York in over 2 years. So that seems pretty bad, Bailey. And of course, we're talking so much about IPOs and this IPO because we haven't seen a lot of IPOs. The fact that we are seeing this cooling, maybe not as much demand as had been hoped. What does that mean for broader sentiment in the IPO market right now?
There's a lot of skepticism, and that's been the big thing, Katie. When you look at the performance, yes, ARM is now up close to 8-9% from its offer price, and Klaviyo is up closer to 20%. But you have Instacart still trading well below its IPO price. You have day one performance for Birkenstock underwhelming. When you talk to bankers and investors, they want a 20 to 30% pop on this day one price. When you open 10% below where shares were actually fully sold, that's just another signal that maybe there's not that demand and the ability for investors wanting to put cash to work, maybe on a company like this.
There is a big question here, too, about just kind of the exit strategy for some of these private capital firms. Obviously, El Cateran was a big player in Birkenstock. Obviously, with ARM, you had SoftBank. And there have been a couple other new issues this year where it was very obvious that the long-term holders, or relatively long-term holdings, really saw this as an opportunity to finally sort of cash out, so to speak, here. Do you think that that is sort of what brings things to market now?
That's been the big topic, especially when you look to 2024, is that the clock is ticking for a lot of these PE firms. They need to get cash back to their LPs. They need to get things out the door. Looking at El Cateran, they're not selling. They have come out and said they don't plan on selling. They view Birkenstock as a long-term investment, but it at least opens the door and gets that clock started after a few years of really a shut IPO window.
And where does the conversation go from here? Because we've had ARM, we've had Instacart, now we have Birkenstock finally coming to market. Who's next, potentially? Who should we be keeping an eye on? One
of the ones that has always come up is Turo, car-sharing app. There have been a number of other firms. The big question is, how do you, if you're a private company or a banker talking to these private companies, which company do you see similar characteristics? Because these companies are so different. Birkenstock, basically, according to them, was founded before America, so a long-standing company that's profitable. You have ARM, which has had its own issues with SoftBank. So what company do you see similarities to? Klaviyo was a good sign for those traditional VC-backed SaaS type of companies.
Founded before America, how dare you? And Turo, is that really going to go public? I feel like they missed their opportunity there.
Well, we've been hearing a lot of expectations for 4Q. I talked to a banker yesterday who basically said the big thing is those companies that we had penciled in for 4Q, if they come out now, that'll be a good sign. But if we see a government shutdown and we see those push into January, February, March, that's when a backlog could really start to build.
All right, Bailey, gotta leave it there. Really appreciate your time. It's great to see you in the office. Bloomberg's Bailey Lipschultz stopping by set to break down.
Are you implying that he's never in the office?
No, I would never do that.
I just like to point out before we move on here that yesterday I was speaking with Scarlet Fu, who, as you know, actually helps to co-host this program for about an hour a day. Do you know she has 8 pairs of Birkenstocks?
I feel like I did know that, but I feel like that's because she tweeted it. Or
which it just rattles me for some reason. I mean, I guess to each her own, but 8 pairs?
I have one.
She's a fan.
Do you have a pair of Birkenstocks?
I have one pair. I bought my first pair this year in 2023.
You know, this ties in nicely to the stat that I want to bring you. There's a lot of great stats in this article. Unlike many of the IPO candidates, Birkenstock is profitable, and I guess you would hope so if it's been around for 230 years.
I mean, if it predates America, which I'm not exactly sure that's true, but if it does, I mean, you would hope that they found profitability after 200 plus years.
Yeah, well, if you have the Scarlet Fus of the world buying 8 pairs apiece, I think that would help. But in any case, Birkenstock not exactly seeing that big 30% pop that you would like to see.
And I'm actually not too surprised by this. I mean, you know, look, they got the cash at the actual IPO. That's clearly what they wanted here, and the secondary market, they'll figure it out. This is obviously just basically one and a half hours of trading right now. And when we talk about the broader market here, Katie, it's kind of been a mixed bag, kind of a mad day. I guess people were waiting for the minutes, were they?
Maybe they.
I don't know. Maybe they're waiting for CPI. I don't know what they're waiting for.
In any case, the S&P 500, it did flip back into positive territory. You're only talking about gains of about 0.1%, and bonds still holding on to a bit, even though we got that weak 10-year auction, and it took back some of those gains.
And a big story developing right now, again, involving these weight loss drugs here now hitting the kidney dialysis companies like DaVita. We're going to talk about that a little bit later in the show. Stick with us. This is Bloomberg. This is the countdown to the close. Equity market's not doing much of anything today. The Treasury market seems like it's asleep, but a lot of activity right now in the commodity space. Abigail Doolittle standing by right now with our commodity close.
There certainly is some trading activity here for commodities. We have the Bloomberg Commodity Index down, really being held down, weighed down by New York crude oil, WTI down 2.7%, back below its 50-day moving average. So the near-term sellers are back in there. This as the crude oil output hits a record high with more gains in focus. European gas down about 7% after gaining more than 30% over the last 3 trading days. So some consolidation of those gains. Copper down 0.8%, and wheat, it also seems to be an ample supply issue, Romaine.
All right, our thanks there to Abigail Doolittle. Before we move on to our next guest, just want to bring you some quick breaking news here. This on Goldman Sachs. Bloomberg reporting that Goldman Sachs has agreed to sell its Green Sky unit to Sixth Street Partners, a consortium, I should say, led by Sixth Street Partners here. We're going to try to get you some more details on that, but that story now crossing the Bloomberg terminal as we speak. We want to stay in the world of finance right now, and particularly in the world of private credit. Growing demand for private credit in an environment of higher for longer interest rates. Our next guest says stay flexible. That's going to be needed so that healthy businesses can grow. Chris Wright is joining us right now. He's the head of private markets at Crescent Capital Group. Also joining in on the conversation today is our very own Sonam Vakil. Chris, great to have you here on set.
Great. Thanks for having me.
Let's start with the rate environment here. I mean, you've been watching, of course, what the Fed has been doing. 525 basis points fed into the system. I'm sure that in addition to raising the hurdle rate has also sort of made the idea of valuation maybe a little bit more complicated.
Yeah, no, absolutely. Look, the markets are certainly in a transition, right? Whether it be the equity markets and for M&A, whether it be the credit markets and how we reset those. And so we have been monitoring it very closely. We have been a beneficiary of the higher for longer market. We've seen a slowdown in the markets as a result, the M&A market in particular, but private credit has certainly become and we've had to become more flexible to meet the demands of the higher rate environment that we're in.
You think about this conversation we've been just having, this idea that Goldman is selling the Green Sky business to Sixth Street. This is a consumer business. It lends the question, do you think that a lot of your rivals are starting to get into the areas of the market that are more economically sensitive that could see more hiccups ahead?
Yes. So I certainly think we have retrenched actually to less cyclical businesses in this uncertain environment. And so when you look at what private credit is doing, they're focusing on service-related businesses, resilient business models, highly cash generative. Certainly the consumer has been strong. And so it's really this kind of flexible capital that I think is going to meet the market demand in this transitional period.
But are there things you wouldn't touch given where we are in the economy right now?
Yeah, certainly, you're staying away from cyclical. When we're looking at opportunities, we're generally the bar to do things in the industrial space, in manufacturing, in retail, in cyclical businesses. The bar is much higher right now, given the uncertainty that we're seeing in the forward-looking views.
And Chris, just to zoom out a little bit, in every conversation about the private markets, I always think about what you can get in the public markets right now. For example, if you look at areas of the junk bond market, you can get high single-digit returns without a lockup period. And when you think about that, what is the pitch to prospective investors to put their money in the private markets?
Sure. I mean, that's a great question. What I would say is right now we can get senior debt in the private markets at 12% with less volatility, greater due diligence, and fewer participants in that. And so we can control our destiny. So higher yield, greater certainty, less volatility, and greater control.
So, Chris, when we talk about this idea of dealing with existing deals that you already have sort of done, but also bringing new deals into the pipeline here, give us a sense here of how that can be structured in a way that I guess appeases, LPs already, and maybe even gets other folks into the fold.
Yeah, look, owners and sponsors of business right now are in this transition period, and they're willing to trade rate and flexibility for equity, right? And so we can come in with flexible capital and provide greater runway for companies to make it through the volatile period that we're in. In exchange, we get paid very handsomely.
I am curious, though, but what's the runway for that? Because, I mean, at some point, I mean, if this period that we're in does prove to be near the end, great. But what happens if this does get extended for a much longer period of time?
If you look at the high yield market in the U.S., high yield market, the loan market, and private credit capital in the ground, it's about $4 trillion. A large percentage of that has been in the ground, and it was put in the ground at a lower rate environment. It's going to take a period of time for that to reset. When you look at the loan and bond market, about 22% of it is going to mature in the next 3 years. And so there is going to be a reset with the dollars that are in the ground. It's going to translate into higher yields for lenders, better terms for lenders. And if we stay in a higher for longer environment, which I think the markets are all signaling, we've certainly seen that.
So you're looking at 5% on the 2-year, but realistically for a risky borrower, what are they paying next year as they refinance?
Yeah, so there is going to be a reset. When you look at what this year, the refinancing in the bond market's been about 100 to 300 basis points. Now, what happened in the refinancings this year is the best companies are getting refinanced. What we haven't seen is we haven't seen the lowest rated companies get refinanced. That is going to be a big reset. That's going to be a 400 to 600 basis point reset that we're going to see. And it's going to come into the hands of private credit because we have the flexibility and can provide that type of capital.
Chris, great conversation. Really appreciate your time. Our thanks to Chris Wright, head of private markets at Crescent Capital Group, and Bloomberg's own Sonam Vakil. Now, still ahead on the close, a shakeup in the energy space as ExxonMobil buys Pioneer Natural Resources. We're going to get into the details of the deal next. This is Bloomberg.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Take Two, getting an upgrade to outperform over at Raymond James. Fans and investors alike, they're eager for information about the upcoming Grand Theft Auto 6 video game. And the analyst over at Raymond James says he expects those details to come soon, and he expects them to be big. The shares actually having a relatively decent day. They were up more than 2% on the day, now only fractionally higher. Next up, let's take a look at Coherent, the maker of optical devices and sensors, raised to buy over at B. Riley, with the analyst there saying he's actually been underestimating the company's silicon carbide unit in terms of valuation and revenue projections. Denso and Mitsubishi Electric, he cites, recently agreed to invest $1 billion into that business, making the value of that silicon carbide unit 10 times its annual 2024 revenue. Shares of Coherent up almost 5% on the day. And finally, Morgan Stanley in a downgrade to neutral over at UBS, with the wealth management firm apparently being challenged by deposit sorting, competition for talent, and the trying revenue environment. That's according to the analyst there. Now, while Morgan Stanley is performing well, the analyst says the stock seems to be fairly priced. At this point, Morgan Stanley, of course, reports a week from today. The shares today down almost 2%. And those are some of our top calls. We do want to stay in the sell side space right now and focus in on energy and a big deal that we've been talking about for a while. ExxonMobil making it official, agreeing to buy Pioneer Natural Resources for roughly $60 billion. Pioneer head Scott Sheffield discussed the need for deals like this when both CEOs spoke with us here on Bloomberg Television earlier today.
Shell companies cannot survive on their own long term. They're going to have to merge up, consolidate, and be part of a diversified company is my general opinion. And this should happen over the next 5 years.
And listening there, of course, today it's a Pioneer and Exxon. Joining us right now is Nitin Kumar, senior U.S. oil and gas analyst over at Mizuho, who has a buy rating on both companies. And let's first start off, before we get to Exxon, Nitin, I want to get your thoughts here on what this deal really means for Pioneer. This is obviously a company that has just kind of came out of nowhere, really established itself as a major player. And now I guess this is the exit for those leaders.
Yes, thanks, Romaine. And, you know, we actually had a top pick rating on Pioneer that we put out not that long ago. The company has one of the most contiguous and differentiated positions in shale. They have most of the core of the Midland Basin wrapped up. They have built that position over many years, but particularly in 2021 when they did a deal with Parsley Energy and Double Point, where they added to that position. And so, you know, this was, I think, in the eyes of many people, a gem. The other thing that the company had been doing had been improving its well productivity and leaning into, more efficient completion methodology. They were really unlocking the value of that asset. And I think this deal is a recognition of the work that they were doing.
There are a lot of questions about Exxon and its role going forward here, how it utilizes the assets that it is acquiring for Pioneer. It's already basically said it sees the synergies, it sees them as pretty big, and it sees them as coming soon.
Yeah, they've nominated about $1 billion second year after the deal closes and growing to as much as $2 billion. A lot of that is dependent on improved resource recovery, bringing the technology of a global leader like Exxon to the Pioneer assets and to shale. And in the clip that you were showing earlier, Mr. Sheffield said this, shale companies have taken the unconventional reserves in the U.S. to a certain technological point, but going forward, being part of these integrated companies with global experience in extracting oil and gas will probably benefit the assets.
Let's talk about what this means for the competitive landscape. When you think about the giant shale driller that this forms, of course, Exxon buying Pioneer, how do its competitors scale up as well? Would you expect more M&A in this space?
So the joint company probably controls around 13% of Permian production in aggregate, and about the same in terms of rigs. So it does create a big player. Our view is, though, that there are other players like Conoco, Oxy, Chevron that have similar scale, maybe not exactly in terms of volumes today, but certainly in terms of reserves. So I don't think there will be a necessary urgency for more consolidation. On the other hand, shale is becoming a game of scale. These companies are focusing on cash returns and cash generation, and that plays towards economies of scale and improved technology. So we do expect consolidation to continue. I just want to be careful in saying that this is going to prompt the other players in the basin to look to do deals immediately.
And we only have about 30 seconds left, but I do want to get your thoughts on Chevron. Of course, you recently upgraded the stock. Chevron, of course, was told by Israel to shut outputs at its Tamar gas platform. Does that shake your analysis at all?
No, not really, because it's very limited impact to Chevron. It's less than 0.1% or less than 1% of their total production, and they're already rerouting that gas through Jordan. So I don't see any near-term impact to Chevron.
Nitin, great to catch up with you. Nitin Kumar there over at Mizuho. A closer look here at a blockbuster deal for Exxon, a tie-up with Pioneer National. Coming up here on the program, a conversation coming up with Ken Rogoff, Harvard University professor of economics, to talk about what's been going on in the Treasury space, the big moves in rates. That conversation coming up after the break. This is Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week daily segment. The host of Wall Street Week, David Weston, joins us as he does every day around this time. And David, you've been gone the last couple of days, but if you remember that relentless sell-off that we've been seeing in Treasuries, it's been put on pause just a little bit, obviously because of the global conflict here. But I think most people expect that uptrend in yields that we had seen prior to this week is going to resume.
Yeah, safe haven really has done something with the war, hasn't it? That's exactly right. But as you know so well, Romaine, really where rates are headed over the longer term is probably one of the more important questions that investors really have on their minds. And so we turn now to someone who has become a student of that very question, and I mean really over the really long time. Ken Rogoff, he's Harvard University professor of economics and chair of international economics. So Ken, thank you so much for being with us. There's something of a debate going on in the economics field right now about whether over the longer term there's a tend to have rates go back down, they were so low for so long, or whether there are other factors that will drive them up. Where are you?
Oh, I'm definitely in the school that they're going to stay high for as far as the eye can see. I mean, whether it be exactly at and I'm talking about the real rate first, whether it's going to stay up at the level it is now, I don't know. It seems to me, a level of the 10-year Treasury of 1.52 would seem natural, but it's very hard to say. That is a way minority view still in academics. A lot of people are very invested in saying, no, this is temporary. It's going to go away after a while. They did all this work on demographics and productivity. But, if you look at the long run on real interest rates, those factors aren't really very powerful. They don't even always go in the right direction. And what is true is when you have a really big drop like we did after the 2008 financial crisis, you ought to expect most of it to go away. There's a slight downward trend long term, but I've been thinking it would go away for a long time. I have to say now that it's happened, I don't know if I was prescient or a broken clock right twice a day, but it seems to me the fundamentals really point to having higher interest rates for a long time. Now going up still really depends on anchoring inflation expectations. Real rates are pretty high now.
Ken, unpack some of those fundamentals, if you would, please, because one of the things that we hear from some people are it's going to be, in part, the demand for spending and investment of things like geopolitics, where we're seeing that right now in Israel. Before that, we saw it in Ukraine. Also some investment when it comes to China. And beyond that, there's the move to climate change, which is going to require a lot of money. Is that part of what, over the longer term, is likely to drive up those rates, because there's so much of a demand for borrowing?
Two of the big factors for sure is a belated recognition that you can't keep cutting money on defense forever. And I'm not just talking about the United States, but Europe. And I think defense spending is going to come up 1% to 2% in both the United States and Europe. If the United States has to, have conflagrations on 2 or 3 fronts or be prepared for that, we're unfortunately need to do more. It's nice if we didn't. And Europe is way underinvested in defense. Japan, China's spending more. That's a factor. And then, David, you mentioned the green transition isn't really happening very fast. But I think if you look out a ways, it's going to involve a lot of big investments, a lot of changes. But I think there are other factors. There's populism, certainly. There's a lot more redistribution of income, concern about just the uncertainty from the, not just the geopolitics creating this uncertainty and splitting up the world. Globalization brought rates down. There's no doubt about it. I mean, Bernanke might have overstated it with the global savings glut, but there was something to it. And now that's in retreat, if only because China is slowing so much. So I think there are a lot of fundamentals pointing to higher real rates.
Yeah.
As for inflation expectations, the Fed's trying to anchor them, but it still has a fight ahead.
I'm curious, though, when you look at kind of that what most people see right now as that secular shift, Ken, in the rate environment here, and you think back to sort of, I guess, what led us to almost a zero-bound rate environment for so many years here, what actually becomes the catalyst that, if at all, would arrest this upward trend?
Well, I mean, eventually they start feeding back into the real economy, and you start, having an effect on investment. Real interest rate gets higher enough, it starts cutting back investment. You have an effect on saving. But I have to say, what we know about bond markets, sort of a lot of research over the last 10 or 20 years is there's a lot of bonds outstanding, but the actual trades is small relative to the number of bonds. And so the rates can be very volatile in the short run, and you have to be wary of that. But I just think the fundamentals just have us in a different world. We had really low rates in other periods. If my work with my colleagues, Paul Schmelzing and Barbara Rossi, it goes over 700 years. But even just in the last couple hundred years, there have been periods when rates have been real high, periods when rates have been real low, and it goes away back to, say, a gentle declining trend. But the kind of changes we saw after the financial crisis, nobody should have thought that was going to be permanent, the secular stagnation, as my esteemed colleague Larry Summers called it.
Well, when you look at where rates are now, I mean, let's just take a baseline, 5% or so on some of the benchmark yields here in the U.S. here. We're not talking, at least on a historical basis, a huge elevation here. I know the rate of change spooked a lot of people, but can a market, whether it's the bond market or the equity market, and the economy for that matter, live with the 5% baseline?
Well, I mean, I think that's exactly the point. I mean, and why investors are realizing that this might be real. The interest rates have gone up, and maybe we'll hit a recession at some point, but the economy hasn't fallen apart as much as you would think. Obviously, there are risks of a financial accident ahead when you raise rates this much. I don't know where it'll be, but it hasn't happened as quickly or dramatically as people thought. And I think that's because the economy is adjusting to a higher rate. And if I can add, people think the Fed has raised rates so high. Well, relative to zero being normal for the real interest rate, or minus, 1 or 2% for the very short-term real interest rate. But if we live in a world of more normal interest rates, they didn't raise them as much as people thought.
Ken, thank you so much. Always such a delight to have you with us. That's Ken Rogoff. He's Harvard University Professor of Economics and Chair of International Economics. So I guess we better get used to these higher rates, right? I wonder if equity holders are ready for that.
Well, I mean, that's what Jay Powell's been trying to tell the markets for a while.
Right, yeah.
To a certain extent, when you look at the price action, though, they do seem, certain pockets of the market seem to finally be embracing this idea that, okay, we're just going to have to live with this because it's not going down anytime soon.
And to your point, which is so powerful, Romaine, there have been periods of time where we've had rates this high or higher, and people have done just fine, thank you, ma'am, including in equities. So it's not the end of the world, even though people seem to think it is.
Yeah, and of course, anybody who would know that better than anybody is Ken Rogoff.
Yeah, exactly. Yeah. Okay. So on Friday, we're going to hear from Greg Fleming. He's Rockefeller Capital CEO. He manages a lot of wealthy people's money, a lot of those really high net wealth individuals. We're going to ask him how they are investing their money in this world. That's coming up Friday on Wall Street Week at 6 p.m. Eastern Time.
All right, definitely tune in for that. And you can catch David Weston every day around this time right here on The Close for our Wall Street Week Daily segment. As we round out into the final hour of trading here on this Wednesday afternoon, a bit of volatility here, but the price action, just certain to agree, somewhat subdued. Equity markets relatively higher on the day, but only fractionally. Similar story in the yield space right now as well. Most of the volatility and most of the price action right now is playing out in the energy space. Crude oil down for yet another day. WTI right back down below $84 a barrel. From New York, this is The Close on Bloomberg. Almost 3 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld.
Let's get a view from the top. Check on the markets here on this Wednesday afternoon. Relatively tepid price action. However, you are seeing some green on the screen with the S&P up fractionally on the day, actually putting together what could be a fourth day of gains, which, believe it or not, Katie Greifeld, will actually be the longest daily win streak in more than a month.
It's tenuous, though. Of course, we've seen the S&P 500 flip back and forth several times today. Currently hanging on to some very slight gains as the bond market keeps its
Is the bond market open?
The bond market is open. Yields are down a little bit. Actually, you're looking on the 2-year, up a little bit. But it was interesting. We got a 10-year auction. There were a lot of eyeballs on this auction. It did not go over so well. Definitely tailed through. So, and that was interesting because really the story this week has been finally that haven complexion of bonds coming back in. Absolutely here.
Though you do see a little bit of a bid in emerging markets. WTI on the back foot once again. Flip up the board here because we came into this morning with a focus on inflation. The PPI numbers came in a little bit hot, though. We should point out when you look at the complexion of those numbers, it seems to suggest we won't necessarily see the same upside surprise out of CPI tomorrow morning here. But you take a look at the inflation expectations here that the Fed tracks here 1 year ahead and 3 years ahead. I don't know. You see the 3 years starting to tick back up just a little bit slightly, but I don't know. You can look at that chart and say maybe they are anchored, inflation expectations.
Yeah, if you're an optimist, you would say, oh my gosh, look at that line. It's come down so much. Of course, the pessimists would focus on that little tick right up. We'll see what the Fed is actually focusing on, and can't wait for CPI tomorrow. Excited to see what.
Are you going to wake up early for that? Or?
I'm going to wake up at 8:29 a.m. But before we get there, let's talk about some of the individual movers today. I want to talk about Exxon and I want to talk about Pioneer. That's really the story of the day. Exxon buying Pioneer for almost $60 billion. Its biggest deal since buying Mobil in 1999. It's a big price tag. It makes sense that you see the price of the Exxon falling today, down by 4.2%. You're not seeing too much of a bid into Pioneer. Typically, you do when a company is being acquired. But remember last week, it had that big rally when we first started getting these reports. It's adding to that a little bit today, up about 1% on Pioneer.
Yeah, I mean, I guess it's a good deal here. What else you got? I saw something else on the board that actually is intriguing me. I'm just waiting for you to get to it.
Okay, all right, let's get to Tupperware.
Yeah, because it's up 40%. Can I just front run you? It's up 40%.
Please.
Why, Katie?
Absolutely surging today to break above $2 per share. So this is a little bit tortured. I'm going to try to get this right. Apparently disclosed in an SEC filing that it's entered into the Fifth Amendment to an existing credit agreement that will, among other things, extend a deadline for delivery of its annual audited financial statements. So still very much a penny stock, if you will. Still a lot of question marks over Tupperware right now.
Okay, so this is more, I guess, just about them trying to get their finances in order. And
exactly.
Yeah, and is still a penny stock, but still a 40% pop on a container maker.
Not bad.
1 hour away from the closing bell, our cross-platform coverage counting you down. That coverage starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues, Jess Menton and Molly Smith, filling in today for Carol Masser and Tim Stenovic, who are on assignment, allegedly. We welcome our audiences across all of our Bloomberg platforms, television, radio, and originals. Jess, you're going to have to do your best Carol Masser impression here. And I'll try not to talk over you, as I never do with her. But give us a sense here of what you're keeping your eye on today.
Well, obviously, to your point, Carol and Tim actually are on assignment. They're on their way to Los Angeles, so they have Bloomberg screen time tomorrow. So they'll be back tomorrow and Friday to go into that. But of course,
and they couldn't leave this evening?
No.
You know, LA is 3 hours behind us.
Well, Birkenstock has been something that has been definitely on our minds here. And I know you were looking ahead to that.
Just ignoring me.
See, I'm doing my best impression of Carol, so keep it going with that one. But Birk is the ticker symbol on that. So it took a while for that price discovery process today, but that stock opening about 11% below its IPO price in its trading debut. But another story on the terminal Molly and I were taking a look at. Birkenstock Brothers bank $3.4 billion in this buyout bet, Molly. So looking at some of these numbers, and especially when you think of this midpoint range coming in a lot, basically not as strong as some of these other recent IPOs lately.
How is Birkenstock Brothers not a reality show?
It's coming. Now that they're through the IPO.
We're going to make them one today. They are making quite the killing today, even if the initial investors in Birkenstock did not, as Jess just mentioned, the stock not doing so well on its opening day. But the brothers walking away with $3.5 billion payout, and I looked at to be a pretty good payoff on this bet for them to hand over control of the company back to the private equity firm Al Cateran back in 2021. So looking to be a pretty good day for those guys.
Yeah, I thought it was interesting, too, about how they've kind of walked away, right? I mean, obviously, I know they still have, a couple of them still have stakes, but one of the brothers is basically completely out, according to our reporting. So kind of interesting that they've decided just maybe to move on and take the money. And that's a lot of money. And I guess they can use that, Katie Greifeld, to get into Disneyland, because which I've told is a lot more expensive these days.
You made my segue for me. I just want to add that apparently Birkenstock is older than America.
Can you
Billy
stop that?
Lipschultz.
Who said this?
Billy Lipschultz told us that. We haven't fact-checked
Can we
it, but
trust him?
it's very interesting. I trust him. I don't know. He was wearing a sweater.
He's great. I love Bailey.
Let's talk about the House of Mouse, because it's getting more expensive to enter it. If you look at Walt Disney World in Florida, annual pass prices are increasing by up to 10%. Meanwhile, a single ticket at the California resort on its most popular days now costs $194. That is an 8.4% increase. Also, parking is going up as well. And this is interesting. It's a touchy subject for Disney. Remember that CEO Bob Iger said earlier this year that the company had been too aggressive in raising park prices. Obviously, maybe a little bit of a reversal today.
Yeah, I mean, look, I mean, anyone who's been to Disney World or Disneyland or any other Disney properties know that, you know, you better bring your wallet and it better be full. So I guess this isn't that much of a surprise. And if you are a fan, I don't know, does a 9% increase really deter you from going?
I mean, I might still go. You know, I know I've got a wedding out in LA later this month. Disneyland's usually a pretty good time. Yeah, I mean, it's obviously like, I think the allure for the park is still going to be there. But like you said, Romaine, I mean, this is not a cheap day, especially when you've got the kids to entertain and wait in the line. So, I mean, Jess, what are your thoughts on this?
I mean, what about Universal Studios or, Matt Miller always brings up Six Flags to me, too, and tries to get me to name.
Can we just be clear, too, that a lot of reasons why people pay this because they have little children who demand to go to Disney World, and you're always going to please your kids. I don't know. My kid was little. I never heard him say, "Oh, let's go to Universal Studios," or to, you know, I don't know. I don't know what else is out there.
I'm not saying it's better. I like all of them.
Before we go, can I just point out here, 1774. Birkenstock was founded, according to the internet. Oh. And as we know, the United States, last time I checked, was 1776.
Could you check that again?
According to the internet.
So they beat us by 2 years.
All right.
I don't know. Who's better, the United States or Birkenstock?
It's a difficult question.
Oh, wait, don't answer that, actually.
Beyond the scope of this simulcast.
All right, guys. Well, that's going to have to do it for now. But we'll be back together in about an hour on live TV, radio, and, of course, YouTube. And on Bloomberg, a quick take at 4 p.m. for our Beyond the Bell coverage when we take you through today's market close.
And we continue our coverage right here on Bloomberg Television, counting you down to the close with just a little more than 50 minutes to go. The Fed speak, it just never stops. Fed Governor Waller saying that the central bank can, quote, watch and see before taking any further action. We also heard from Michelle Bowman, noted that rates may need to rise further and stay higher for longer than previously expected. We also heard from San Francisco Fed President Mary Daly saying that the neutral interest rate could be higher now than before the pandemic. Let's get some insights out of our next guest. George Bory joining us, Chief Fixed Income Strategist over at Allspring Global Investments. And George, it seems like no matter what the Fed speakers are saying, most people in the market seem to believe that if we're not at the end of this rate tightening cycle, it's certainly right around the corner.
Well, yeah, I think that's absolutely true, Romaine, and thanks for having me on the show. Over the last week or so, the narrative certainly has shifted from the Fed, and they do seem to be positioning, much closer to a pause or a skip, or, we can call it sort of whatever you want. But basically, they seem to be guiding the market to to expect no action at the next meeting in a couple weeks' time. And that is a notable shift. They're trying to leave as much optionality kind of available as possible. Yeah. And you heard, kind of the discussion to say they might need to eventually raise rates again. Mm-hmm. But higher rates, tightness in the financial markets, geopolitical risk outside of the U.S., all amounts to, we think, enough cover to let the Fed sit tight once again and allow the tightness in markets to continue to work their magic. We'll see tomorrow. We'll see what the inflation data shows. Yeah. But we think the Fed's done enough at this point.
I am curious about the market reaction to this rise in rates, and I know the rate of change spooked a lot of people. We were speaking with Ken Rogoff in the previous hour. Of course, has done a lot of research about the neutral rate here. And a great point here is this idea that the rise from basically 0.25% to 5.25 on the Fed funds rate isn't really, a shock so much as kind of just returning us to what the long-term average is. I was just looking at benchmark yields in the post-war era, and that average, at least on the 10-year, 5.8% here. So we basically just returning to, I guess, what some people would say is where we should have been probably for the last 10 or 15 years.
I think you're absolutely right. I mean, there's two sort of main factors. One, from a pure fundamental perspective, if the U.S. economy on a nominal basis grows at about 5%, which it does, and you have inflation, we can be generous and say it's not going to get all the way down to 3. It gets kind of closer to 2. I'm sorry, to 3 rather than 2. Then you're sort of looking at a nominal yield around kind of 5% is not out of the realm of kind of fair value possibilities. It makes a lot of sense when nominal yields and nominal growth are kind of roughly in line. That's number one. And then, as you point out, number two, the great experiment of the zero interest rate policy, of the intensity of quantitative easing, and basically, sort of controlled interest rates, both in the front end of the curve and out along the curve, have been unwound. And then the final kind of message came from the Fed very recently when they basically admitted like they will and are likely to keep rates higher than perhaps the market expected. So don't expect policy to go right back to where it was 2, 3, 4, even 5 years ago. And to us, it's a great renormalization, if you will, of both front end expectations, your point about the natural rate, or the neutral rate, I should say, as well as the structure of the curve, kind of call it the 4.5 to 5.5 sort of range for both the front end all the way out to the long end. To us is actually quite it makes a lot of sense from a cyclical standpoint.
Well, George, let's talk about how you invest against this backdrop, because I look at your notes, I see that you've been adding small amounts of duration to your portfolios. Let's talk about duration. Are you talking about 5 to 7 years, or are you talking about 10 to 30 years?
So we have been moving out really from very front end to 2, 3, 4, 5-year points on the curve. Obviously, the 5 years gone up. The 2 years been fairly well anchored, but we have been incrementally adding duration. With the steepening of the curve, say 5 years and out, now longer-term duration is starting to look relatively attractive as well. So we have had incremental duration adds, if you will, and we would emphasize the incremental component. it. But as the curve has steepened, as real yields have gotten more cheap or have cheapened up, kind of taking incremental duration further out the curve is now starting to look, at least it did, late last week and earlier this week. But as we get back down closer to 4.5% on the 10-year, it's becoming a little less compelling. But I would say if we get up towards 5% for the 10-year, that would be a very attractive entry point from our perspective. And we would think about kind of extending that duration that we've already established in the portfolios.
And George, we don't have too much time left, but let's get extreme here. When we talk about 10 years, when we talk about 30 years, is the bull case at that part of the curve basically just a bet that we're going to see a recession?
I think it's two things. One is this ongoing deceleration or kind of decline in inflation. We'll see what core shows tomorrow. If it shows an ongoing moderation, that's the fundamental validation of, kind of the underlying trend. That can help yields come down. A dramatic move, so something closer to a 100 basis point drop or more, that would have to be recessionary. But just a little bit of cooling on the inflation front, at least even if it's just core, that we think would be just enough to continue to bring down bond yields.
All right, George, it's great to check in with you. Our thanks to George Bory, Chief Fixed Income Investment Strategist over at Allspring Global Investments. Now, coming up, U.S. producer prices rise more than forecast. We'll talk with Lara, Rhame, Chief U.S. Economist at FS Investments, and get her insight on what to expect from tomorrow's CPI report.
Yeah, we had a summer of big tours. It really revitalized the live event space. We're going to talk to Stan Chia, the CEO of Vivid Seats, to get a checkup here on the health of that industry.
And we'll speak exclusively with NHL legend Mark Messier. He has a new venture called Game 7. He's going to tell us all about it. All that and more coming up. This is The Close on Bloomberg. Well, it's time now for our Muni Moment, and according to data compiled by Bloomberg, municipal debt sales on track for a second straight year of declines. States and cities have sold $273 billion of munis so far this year, which is down 8% from a year earlier. Now, at the same time, though, Bank of America forecasting muni sales will rise to $400 billion in 2024. Let's break it down now with Lyle Fitterer. He is co-lead for the municipal sector and senior portfolio manager over at Baird Advisors. Lyle, it's great to have you with us. Do you share Bank of America's optimism when it comes to maybe a rebound here in muni sales?
I think we would share their optimism that we'll have a rebound. I'm not sure we'll get $400 billion. We really don't try to predict what that number is going to be, but I would agree it's probably going to go up. State and municipal governments benefited from the federal stimulus money that helped them. They didn't have to come to market. We all know there's a lot of deferred CapEx per se within the muni sector, whether that be infrastructure or other areas. And so we would expect it to go up. And even this year, tax exempt issuance is actually up slightly, but taxable issuance is down quite a bit.
And what would that mean for the muni market if we were to see supply return to a more normal level? You know, the narrative we've been hearing is the fact that you've had this dearth of sales has been a bit of a tailwind for the industry. If we go back to maybe more normal levels, will that tailwind disappear?
Yeah, I'd like to think that money's going to start flowing back into munis. It started to flow back into taxable funds. I think we've seen 160 billion or something like that come into taxable funds. Muni funds, at least so far year to date, are negative. But I think if people start to look at the tax-adjusted yield on municipals right now, in some cases 8-9% on a tax-adjusted basis, that compares very favorably with other sectors. So I think it could be a headwind for the market, but our expectation would be that we start to see flows pick up into the industry as well.
Of course, I mean, when we talk about the potential income that you can get, you talk 8-9%. Of course, investors can't just look at it yield alone. Obviously, they have to look at kind of the general makeup of what they're buying here. Yep. And obviously, we know muni market is very vast. So I'm curious, are there certain pockets of the market that you think offer a little bit more, I guess, stability, for lack of a better word?
Yeah, I mean, right now our focus would be a little bit more what we would say up in quality, so buying higher quality securities if you look at the yield of a AA rated bond out long relative to, say, a BBB rated bond, it's around 80%, which from a historical perspective is on the higher end. So you don't need to reach for yield. Again, 5% tax adjusted, and again, that would be on the long end. Even on the short end, you can buy stuff at 4%. Yeah. You adjust that for taxes, and you're talking 6-7%. So again, I think it depends on the investor, their time horizon. We are suggesting that people should probably think about pushing out their duration on their portfolio. A lot of people we think are still sitting in cash or T-bills. And they had an opportunity last year around this time. We think it's another opportunity to potentially put some of that money a little bit further out the curve.
But I am curious, when you talk about pushing out duration, I mean, the conviction in order to do that is that obviously you think that rates at least have either reached a peak or are close to it, and you want to lock that in. Is there some sense here that investors really haven't gotten that signal yet and still think that we could see a meaningful increase?
Yeah, again, I think there's a difference in the market. I think if you look at what's going on the taxable side, which a lot of that is more benchmark-focused asset liability mix, we're seeing that already. We're seeing people rotating out other sectors back into what we'd call core fixed income. I think the muni market tends to react a little bit more slowly. We are seeing it, I think, in direct muni sales to individuals. Mutual funds, though, haven't seen it yet. And so, again, I do think that you do have to have a belief, obviously, that you think you're near the top. You don't have to be at the top of the rate cycle. Even if you think rates are going to stay in a range, whether that be from 4 to 6%, it's probably not a bad time to still tiptoe into the sector.
And so just quickly, maybe it's time to take on some more duration risk. How are you thinking about credit risk right now?
Credit risks, we're being a little bit more cautious. Credit in the muni market, I think, has performed very well. If you look at the corporate market, it's also performed well, but it's stabilized. Credit spreads came in. They've kind of been hanging out at the, at kind of average type levels from a longer term perspective. The muni market, we've continued to march tighter if you look at kind of BBB muni spreads or within the high yield sector. Here recently, maybe with the sell-off the last couple of days, it's cheapened up a little bit. But we're seeing stuff in the market today at, say, in the high yield sector at a 6%, the same level it was at the end of the year, but high grade bonds are yielding 60, 70, 80 basis points more, so substantially tighter. So again, our view would be you don't need to take that risk. You can get pretty compelling levels by staying in the investment grade sector.
All right, Lyle, great conversation. Lyle Fitterer here for our Muni Moment today, the co-lead for the municipal sector and senior portfolio manager over at Baird Advisors. A lot more coming up here on The Big Show. Stick with us on The Close on Bloomberg.
Well, the most likely topic to spur a boardroom battle, it's return to office policies. That's according to a poll by Gartner. RTO mandates were cited as the issue that had the greatest potential to foment conflict among leaders. That actually came ahead of very charged topics that includes layoff, diversity, ESG, and the adoption of AI, which makes a lot of sense. You think about your day-to-day life, where you physically are matters.
Well, so when they say boardroom battles, is this because the actual people on the board aren't actually showing up to the office, and but they're asking everyone else to? Because this has sort of been the conflict, right? I mean, all these bosses, they're basically saying, oh, we want people back, and it's better here. But then, of course, they're giving these edicts on Zoom from their villa where they're living.
They blur out their background.
There was an interesting stat in this story on the Bloomberg terminal. It was a survey by Unispace where they said 4 in 10 employers who implemented mandates for return to office have experienced higher than normal attrition rates.
Well, what did we see at Grindr? It was some outrageous percentage of their employees left after mandating that people come back. So, I mean, I think that's going to be one of the stories that we follow in the labor market over the next several years, what the attrition rates actually look like, whether there is more turnover or whether this truly is a talking point.
Yeah, I'm just fearful when they finally call us back, as our viewers may not know. We're actually doing this from our basement down at the docks.
A very elaborate setup. But yeah, I mean, it'll be interesting. A lot of companies, anecdotally from my friends, have said that this is sort of a recruiting tool that some of these companies use. You can have flexible work arrangements. Not true at the banks.
From your friends, John. Okay, people are saying things.
People familiar.
People familiar. Stick with us. A lot more coverage coming up here as we count you down to the close. This is Bloomberg. This is the countdown to the close. About 30 minutes left to go here in the trading day.
And you can see the S&P 500 building on tepid gains. It's getting some help from real estate. Actually, if you take a look at the sector level right now, you have 6 sectors in the green, 5 in the red, being led to the upside by real estate. That's up 1.8%. That's followed by utilities, communication services, and big tech, too, hanging on to some gains here. You look at what's not doing so well, Romaine. You have healthcare, consumer staples, and then at the bottom, it's the energy sector, currently off by about 1.7%.
Yeah, let's take a look at some of the individual movers. To the downside, a lot of the life sciences companies and medical device companies are really getting hit today. Boston Scientific down about 6%, having its worst day going back to at least early 2022. And this all seems to be tied to some earnings that came out of another device maker named Silk Road Medical, which actually plunged about 40% here on the day after they came out with some preliminary earnings here. We're actually going to check in a little bit later here on the healthcare space, also getting batted around by some of the concerns about the impact from those weight loss drugs. Ally Financial taking a leg down as well on the back of the news that its long-serving CEO, Jeffrey Brown, plans to step down early next year. And, of course, the changing of the guard at Walgreens Boots Alliance, that's pushing the shares a little bit higher. Of course, we know Roz Brewer was already on the way out, but the company has confirmed what Bloomberg has been reporting for quite some time here, that they have found a new leader in the name of Tim Wentworth. LVMH, though, we have to talk a little bit about this, and we can flip up the board here, down again here, 6% here, the shares over there in France trading down on the day. But this has really become a big rout here for a lot of the luxury goods companies. Remember, the head of Richemont just last month, which makes, of course, the Cartier brands, basically said that inflation was really starting to take a bite out of the higher end consumers, that they were really starting to scale back. You're looking right now at the European shares of LVMH carrying Hermes as well as Richemont, and you can see the downturn that we've seen just over the last couple of months. Remember, just in the first 6 months of the year and really going all the way back to early 2022, these were the star outperformers in the market, Katie Greifeld. No more.
Well, on the topic of inflation, U.S. producer prices came in hotter than expected this morning, really bolstered by higher energy costs and food prices. Let's break it down with Lara, Rhame. She is chief U.S. economist over at FS Investments. Great to have you with us, Lara. And when I look at the data that we got this morning, should I just brush it off as being due to largely energy, largely gasoline, or do you think there's something troubling here?
You know, I think we're starting to see inflation not necessarily be troubling yet, but not be quite as cooperative as it's been the last several months. Both PPI and the producer and the consumer price indices have for months now really been at the core level coming down pretty significantly. And I think this coming month, we could see some other places where inflation bubbles back up again. Goods price disinflation has slowed. That process has become more uneven. And we're looking at food. We're looking at energy working its way into other sectors. I think we could see tomorrow's report give us a little bit of an upside surprise, even in the core number.
Well, that's where I wanted to go. When you think about what we got this morning, the big surprise that we saw on PPI, when you extrapolate that over to CPI, and particularly some of these core measures that we know the Fed pays attention to, what's your expectation here?
It's been interesting. You know, the Fed has really driven us to look at this smaller piece of CPI, that they look at sort of the services sector excluding shelter. The idea being that this is a very wage sensitive part of the services economy. I think that in some ways the Fed has been its own worst enemy, because while this area has come down significantly, it did actually rise more than expected last month. I think we still need to be well aware of the fact that inflation in any form really erodes wages, really erodes purchasing power. And I think the Fed has in some ways made us too focused on this smaller measure. I think that measure has, again, last month rose 0.4%. Prior months it had been 0.2. We even got 0.1. I think it's going to settle, and we'll see what it is tomorrow. It's hard to forecast these little slivers of growth, and we've seen wage pressure come down a little bit. But, going forward, I think the problem for the Fed could be that if we get this one smaller, very, sub-index behaving well, and we get food and energy prices up a lot, rents continue to stay elevated, they may have done us a disservice by focusing so much on this smaller piece.
I am curious as to the communication mechanism, though, coming out of the Fed on this particular issue and the way that the market has interpreted it, because as I'm sure you've seen, Lara, I mean, you're a very smart person. I'm sure you got plenty of leather-bound books behind you somewhere. But when we talk about this idea of whether the market is sort of preparing for that proverbial soft landing or whether they are still fearful of recession here, are they getting, I guess, consistent enough communication out of the Fed and out of the economic data, for that matter, to make that determination?
We're really not yet. And this is something that is continued to cause this swirl of expectations in markets, because a lot of the leading indicators, a lot of the leading sentiment indicators are still quite negative, while the current indicators are fairly strong. And I think exactly to your point about communicating from the Fed, they can absolutely declare progress on inflation, but they cannot declare victory. And in fact, it could be several quarters still until we're back down to inflation at levels that are even remotely close to 2%. So to me, I think 2024 is going to be a year of very difficult policy choices for the Fed.
Yeah.
I think inflation is going to stay uncomfortably high, and it's going to be hard for them to navigate that as the economy probably slows from current levels. Let's face it, growth in the third quarter has been unsustainably strong. We're not going to be able to maintain this pace of growth indefinitely.
I want to ask you kind of an esoteric question, and maybe you can't answer it, but we were speaking a little bit earlier with Ken Rogoff about the direction of interest rates and the level that they're at here. And there is a question here about the neutral rate. No one quite knows what it is. I'm not even sure the Fed knows what it is. But is there a sense that in whatever direction we're headed right now, that neutral rate by default maybe has to be a little bit higher, I guess, than it was in past cycles? The idea here that maybe what we're looking for here is at a higher threshold than what I guess the Fed has been trying to communicate to us.
I think that this does raise, and of course, I don't have a one number. Nobody does. But I think what he's touching on is the fact that the last 15 years have been true outliers from past episodes where really, interest rates have aligned with growth much more closely. And the last 15 years have seen interest rates sharply below growth. Again, this isn't a year-by-year rule or a quarter-by-quarter rule, but over the very long term, you do see some alignment, outside of the Fed trying to push us one direction or the other. And the last 15 years, where 12 of them, we had the Fed funds rate at zero and long-term interest rates really suppressed by quantitative easing, have been true outliers. And I think even if we return to normal, it automatically implies interest rates that are here or even higher, at least in the long-term, part of the yield curve.
Lara, great to catch up with you ahead of tomorrow's CPI release. Thanks to Lara Rhame, Chief U.S. Economist over at FS Investments. Now coming up, shares of dialysis providers DaVita and Baxter fall after Novo Nordisk said its blockbuster Ozempic medication showed effectiveness in treating kidney failure. It's our stock of the hour coming up next. This is Bloomberg.
All right, time now for our stock of the hour. A look at Novo Nordisk. Those shares rising after announcing its blockbuster diabetes drug Ozempic is also effective in treating kidney failure. That's actually putting a strong downdraft here for names like DaVita, which is down about 20% on the day, and Baxter down about 12% here on the day. Madison Muller joining us right now, who covers healthcare for us here at Bloomberg News. And let's start off about what we know about this particular study. What is causing, I guess, Novo investors so much joy and investors in some of these dialysis makers a lot of concern?
Yeah, so like we're seeing, I mean, Ozempic, Wegovy, they might have other potential uses beyond diabetes and obesity. And so in this trial, they actually had to stop it early because the effectiveness was clear and they didn't need any more data. And so Novo is still blinded from the data for a bit until early 2024. But what this trial showed was that in patients with chronic kidney disease and diabetes, these drugs helped stave off dialysis, helped stave off kidney failure, which is not great news for makers of these dialysis machines, because that means potentially that less patients will be going on to dialysis, or that at least it will be longer before they need to go on to dialysis.
And so we've been talking about Ozempic and Wegovy sort of as a block, but this is specific to Ozempic, correct?
Yeah, this is for patients with diabetes, because diabetes is a precursor for many different other health conditions, one of them being potentially kidney failure, chronic kidney disease. So this study was specifically looking at patients with diabetes.
There's some concern here about how this sort of trickles out here. I know we're heading into earnings season, and maybe some of these companies are going to have to sort of come clean as to whether they're seeing a material impact. Of course, we've heard from Walmart, we've heard from Pepsi. I know we're going to hear from the medical device companies, Abbott Labs among them as well. What are we expecting?
Yeah, so next week Abbott is reporting earnings, and Abbott, like other medical device makers, is one of the companies that could potentially be affected because they make continuous glucose monitoring devices as well as devices for different heart diseases. And these drugs treat diabetes, which helps with blood sugar and keeping those levels stable. Also have shown to help cut the risk of stroke and heart attacks. So it could be bad news for these companies, but we don't know yet. We haven't seen that impact. Analysts say that next week during Abbott's earnings, that could be the first time that if we do see an impact, it might show up there.
And Madison, this is a bit of an impossible question, but it just feels like there's so much hype around some of these weight loss drugs. I mean, the fact that you're seeing some double-digit losses just on a mention here, it almost feels like sort of an AI moment, but we're talking about healthcare.
Yeah, it's really interesting. I mean, there was a note from analysts today that said that it could be 15 years before we actually see the number or the patient population for kidney disease shrink. And so I think it's early. It's very early to know the impact of this. It could be pretty far off, but the market's clearly reacting to any news that comes out about these weight loss drugs, diabetes drugs. So it's just, we're watching and waiting to see what happens.
All right, Madison, of course, keep an eye right now on Novo Nordisk, our stock of the hour, as well as some of the device companies and kidney dialysis companies now significantly here on the back foot on the idea, Katie Greifeld, that at some point, I guess we're all just going to be on a weight loss drug and we won't be eating anything, we won't have any health care. This is like a wonder drug.
And it's coming for every industry.
I know, I kind of want it now.
Yeah, I mean, yeah. I'm interested to hear how that goes. I don't know.
I don't know. Will it give me more energy, make me stronger?
There's only one way to find out.
All right. Coming up here, we count you down to the closing bells, 14 minutes until we get there. Dan Suzuki going to be stopping by to help us in that effort. Richard Bernstein Advisors, Deputy CIO. Stick with us here on The Close on Bloomberg. This is the countdown to the close. Romaine Bostick here, joined now by Scarlet Fu, who joins us every day at this time to help count down to the bell and beyond. And Scarlet, it's a somewhat tepid day here in the equity space and even the Treasury market not doing a whole lot. A little bit more activity in commodities right now here. But I think this is kind of that weird sort of nether region between that PPI report we got this morning, which came in hot, and the CPI report that everybody still thinks is going to reaffirm that narrative of disinflation.
And of course, the start of earnings season later on this week as well. Look, the Fed was maybe going to give some more clarification on its thinking. At least that's what the market thought. But what it got was more uncertainty. And it feels like right now, with indexes turning higher, we're climbing a wall of worry. There's a laundry list of things that keep stocks kind of held back a little bit here, and bond yields really swinging.
Yeah, absolutely here. I mean, you take a look at some of the numbers on your screen, and honestly, not a whole lot to write about. Of course, we've been talking all day long about, I guess, weight loss drugs, Carl. I don't know if you're on Wegovy or Ozempic yet, but I'm told that at some point the entire population of the world will be on this, and we won't buy chips.
No one's going to eat snacks, right?
Soda pop, and apparently when we need to have dialysis or anything, it'll be like a wonder drug.
We'll see. I mean, people are getting really worried about it for sure.
All right, let's get some insights into what's going on in the market and beyond. Dan Suzuki joining us right now to help count down to the closing bell. Richard Bernstein, Advisors Deputy CIO. And Dan, actually, let's start with earnings here, too. I mean, we kind of joke about Novo Nordisk and Wegovy or Ozempic, whatever the heck they make. But at the end of the day here, and this is kind of one of those transformational things for a company, should it actually stick. And there's been a lot of talk about other pockets of the market and the economy that are also seeing that type of transformation, whether it's with AI and some of these other things here. I know there's a lot of hype around it, but when do we start really being able to see whether there's a fundamental story, corporate fundamental story here?
I think you should be able to see. I mean, I think you're seeing it already, right? I mean, I think it's a little too early to see the full broad implications of all these major disruptions and changes, but you're seeing the investment, that goes behind it, to build that infrastructure for the future. And I think that, so you're seeing it today. The question, I think, and I think the issue is, what people have to understand is there's two sides of the transaction. And it's like for every transaction, you're giving something to get something. And so we understand there's a big opportunity in what you're getting, that future growth, the future story, but what are they giving? And I think you realize is you're probably paying too much for that, and you're basically getting in a bidding war with everyone else that wants to jump on board, and that's the concern.
And that's been sort of a narrow trade. We've seen that, of course, with the big tech stocks, and of course with AI, and we're probably seeing that with some of the weight loss drugs as well. As we head into earnings season, which ostensibly starts this week here, but once we get deeper into it, there are some shorter-term concerns here about margins, about interest rates, and I guess just how companies are sort of adapting to what most people believe is a higher interest rate environment for longer.
Yeah, I think, as with anything, there's usually some winners and losers here. I mean, I think that ultimately, if you step away from the tail of the snake and look at the head of the snake, ultimately this is coming back. There's some structural inflation issues, but the reason that you have to worry about inflation really being a sustainable problem here is that growth is showing signs of picking up. And if that's the reason, there's clearly going to be some winners there. And so it's not all bad. You just have to watch out for the lower quality companies that have more exposure to higher interest rates, more floating, shorter maturity debt. But if you're not in that camp, which is probably the minority within large corporations, you're actually probably going to get the bigger benefit from the boost in profits and the boost in growth that we're seeing.
I feel like we're in this very confusing period, right? Are U.S. households healthy or are they stretched? The job market is tight, but only in certain sectors for certain kinds of jobs. Consumer spending is definitely there, but student loan repayments could put a stop to that, right? There's so many ifs and whats and, pieces of that. What's the common thread linking companies that are successfully managing through this period and thriving?
I think you hit the nail on the head, Scarlett. I think it's really about levels versus direction. And usually for markets, it's really all about direction. That's the important driver. Market doesn't care about the absolutes of good and bad. It cares more about better or worse. But if you think about what's happening in the economy, the disconnect is the levels are so extreme coming off of these pandemic distortions that they start to matter. Right? If you think about the consumer, on the margin, the consumer's weakening. You're seeing more stress in the lower end parts of the consumer, but the level of money and the level of the strength of the balance sheets that's out there is still incredibly healthy. And if you look at like income growth, we're still just now getting to the higher end of the historical range. And that's true with all these different metrics all over the economy, is that the levels coming down, things are slowing, but from such a unsustainably high level, this is to be expected.
Right. So the minutes that we got today showed that the Fed can now proceed carefully when it comes to monetary policy. Is this kind of the same approach that investors are taking when it comes to adding risk, proceeding carefully?
Yeah, I think that's right. And I think, if you get to the heart of it, I think there's never really a real true consensus within the markets about where risk is. Like typically where people think investors think that risk isn't is where the risk is, and vice versa, right? And so it's that mispricing of risk that creates those opportunities, and people really getting caught off sides when you get these big moves in markets. So I think that people are trying to proceed cautiously here, but as an example, we know that the one area of perceived safety this year has been the Magnificent Seven. Now, if that proves to be the safe haven, then they will have been proven right. But I suspect that people are overestimating the amount of margin of safety that they have in these names.
Well, is there a margin? Is there sort of a pocket of safety in the market right now that you find? I mean, obviously we know that some people would look to the Treasury market, but when you look at the volatility that you've seen there, I mean, I can understand from a buy and hold perspective, maybe that offers a modicum of safety. But what's an entry point?
Yeah, no, I think you're right, Romaine. I think that, typical areas of perceived safety, they have a lot of issues, right? What's the classic safe haven? To areas would be treasuries. Well, obviously, they haven't been shown to be safe havens. There's the yen, hasn't been shown to be a safe haven, and there's gold, which is just had a big sell-off, right? So I think that right now, as you look at safety, I mean, I think that you've seen the huge pileup in money market holdings. I think cash is the clear, area of safety today. Outside of that, you have to have a view. You're taking a view on something, and even with cash, you're taking a view on the Fed. But at least, there's some visibility there relative to other things.
All right, Dan, always great to talk to you.
Thanks, guys.
We should point out, too, on the cash front, Tom Keene, he was like in the triple leverage cash fund like 10 years ago. So
is that right?
He was a man ahead of his time.
People were saying cash is trash. You got to listen to Tom. Tom is the bomb.
We're going to clip that and send that to Tom Keene, Dan Suzuki, from his lips to God's ears, Richard Bernstein Advisors. Always a great conversation as we count down to the close here. About 2.5 minutes until we get there here. Most of the major indices are green on the day. The Russell 2000, that's your main laggard here on the day, Scarlett, but that's only down 0.1%.
Yeah, and it's really pretty much been a straight line up over the last 30 minutes or so. I mean, at midday, it was mixed. That hot PPI report didn't do much in terms of really keeping spirits low. A bit of a snoozer here, and I think people are waiting for the big show with CPI tomorrow, as well as the official start of earnings season. As we move closer to these closing bells here on this Wednesday, our full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlet Fu. We're counting you down to the closing bell. You're here to all take us beyond the bell. It's a global simulcast with our friends Carol Massar and Tim Stenovec, who've decided to take the day off and instead have handed over the duties to Molly Smith and Jess Menton. How you guys doing?
We're having a blast over here. We do miss both of them, but we're still having a good time. But taking a look at, we only have, about 2 minutes left before this closing bell, but the S&P 500 is trading right now, still below those summer lows here. So it's going to be interesting how things shape up ahead of that CPI report tomorrow morning.
Yeah, and of course we got, the Fed minutes today to lead us into that that next CPI report a bit. So looks, still to be that same higher for longer narrative. We've heard it before. You'll hear it again. So not a whole lot of news coming out of the minutes today, but we've got a few more Fed speakers coming up too. So I'm sure they'll have more to weigh in on.
Yeah, the PPI report that we got this morning certainly backed up that higher for longer idea. Now everyone turns their attention to CPI and whether we actually get those numbers down to some meaningful disinflation that will continue.
Yeah, and the CPI report, we'll see what that delivers here. Of course, also earnings season is basically, it might as well just call it underway. Of course, we get Walgreens and Delta, I think, tomorrow morning, and a couple of the big banks on Friday as we head into the following weekend. I think this is going to be one of those critical earnings seasons where people really want to see how these companies have held up to that inflationary pressure, whether they've been able to pass that cost on to the consumers the way they did in the first and second quarter. That appears to be waning already. The question is, how much is that going to weigh on margins? All right, we're getting the closing bells here in New York here on this Wednesday afternoon here, and it looks like a relatively good day. I think some investors will take it. A fourth straight day of gains for the Dow Jones Industrial Average, which is up about 0.2% here on the day as we wait for these numbers to settle. A similar story for the S&P 500, up almost 20 points or 0.4%, and the Nasdaq Composite higher by almost 100 points or 0.7%. 4 straight days of gains there for 3 of those major indices. Meanwhile, let's turn to the Russell 2000. That was your relative laggard Nasdaq on the day. Remember, the Russell 2000 had put together 5 straight days of gains. There won't be a 6, down 0.1% here on the day. As you hear the clapping and the bells there, you see the CEO of Vivid Seats ringing the bell there at the Nasdaq. Actually going to be speaking to him, guys, in just a minute here on the close.
Looking at the daily advancers, about 60% of the stocks in the S&P 500 higher, about 296, and then 206 decliners there, or about 41%, Scarlett.
Yeah, let's take a look at the best performing sectors and laggards as well. You've got real estate investment trusts and utilities, very interest rate sensitive groups taking the lead here, up by at least 1.7%. Chip makers also gaining by 1.4%. On the flip side, take a look at the big decliners here. Healthcare equipment and services index. I'll just say that's the Ozempic effect taking effect here in that sector. And energy stocks lower by 1.3% as oil prices continue to fall. Household and personal products, another defensive group, also losing 1%.
Well, speaking of what's happening with some of those healthcare stocks, Scarlett, looking at Eli Lilly, ticker symbol LLY, that stock up about 4.5%, so its best day since August 8th earlier this year. So this did come after Danish drug maker Novo Nordisk did say late Tuesday that it was halting Ozempic's kidney disease treatment trial after a committee said that analysis showed signs of success. So even though that did hit shares of some of the world's biggest kidney dialysis providers, you are seeing some of these healthcare stocks like Eli Lilly rising. Also another one rising too, and also closing higher today, is Amgen, ticker symbol AMGN. That's up about 4.6%. So best day also since August 4th. So looking at that biopharma stock, it was upgraded by Leerink to outperform there. So that's another one gaining. And then of course, Plug Power. We're actually going to have the CEO, Andy Marsh, who's going to be joining us later on in the next hour with Molly and myself to discuss the company's green hydrogen ecosystem strategy. But when you're looking at that stock, up about 5.3%, so on pace, it was actually closed at its best day since October 10th, but the company is forecasting a rise in revenue to roughly $6 billion, Molly.
And over in the decliner space today, in some not as clean energy, looking at Exxon buying Pioneer Energy for $60 billion in an all-stock deal. Exxon shelling out $253 a share for this. It's going to make Exxon the biggest player in the Permian Basin. So shares down about 3.8% to end the day on that mega M&A deal. Going to Birkenstock next, IPO day for them. This was the big debut that a lot of people were looking toward, especially because we've had some mixed performance and some bigger IPOs lately. A lot of people really looking to this one to see if it can set the tone for some other companies that might be waiting in the wings to go public. Unfortunately, not such a great day for Birkenstock, falling, let's see, about 12.4% to start the day. Not the best debut for the sandal company there. And taking it over to the Ozempic effect, as we've been talking about, on some of these kidney dialysis makers. So Ozempic was found to be pretty effective in a kidney failure study. So all of these dialysis makers like DaVita, that's the one I'm looking at today, were not doing so well in reaction to this. So DaVita closing the day, that one was down over almost 17%, Romaine.
All right, let's get a quick check of the yield market here on the day. It was an interesting day in Treasuries. We continue to see a bid come in to Treasuries. That's partly, I guess, on haven demand, if you will. That actually pushed yields down lower pretty much across the curve, with the outlier being the 2-year yield, which did tick up higher by about 1 to 2 basis points. We should also point out, though, a lot of the price action really did shift around 1 p.m. here in New York when we had that latest 10-year note auction, which tailed once again here. So we're continuing to see weak demand, particularly for some of those longer dated sales that the Treasury is doing. A ratification, I think, of the idea that investors are indeed demanding a bit more yield to step up to the plate here. And of course, that's going to be a big focus as we head into a big data point tomorrow with CPI. And of course, as everyone looks ahead to the big Fed meeting at the end of this month. But before we get there, guys, I just have to go back a little bit. I want to talk about Birkenstock because, I mean, this was a bit, I mean, you laugh. I mean, Scarlett's, I found out this yesterday. She's a big fangirl of Birkenstock. She has like 18 pairs of Birkenstocks.
Oh, wow.
Including
Really?
Minus 10. Okay, I might exaggerate a little bit, but she loves them. And look, I don't think anyone doubts the power of this brand and its name recognition, but this was like one of the biggest flops in terms of the actual trading flop, meaning on the first day of trading that we've seen in a couple of years. And it really makes the question here whether this was specific to Birkenstock or maybe a broader concern here about some of these IPOs IPOs coming to market.
Or maybe just bad timing. You have a lot of question marks over the health of the consumer going forward. Yes, Birkenstock has done really well in its financials, but it's counting on being able to build on that momentum at a time when the consumer is getting more and more stretched and the bite of inflation is affecting spending patterns.
Yeah, Bailey Lipschultz on our U.S. equities team, one of our star reporters, pointing out how when it came to this IPO, pricing at the midpoint of that particular range, whereas a lot of the other gangbuster IPOs recently were at the higher end. So really, what does that tell you? And to your point, Romaine, whether this is more exclusively toward this particular company or if this is a sign more broadly about what potentially could be to come here.
Yeah, and obviously, we had mentioned this was not a great day for the investors here in Birkenstock, but was a very good day for the brothers who are of the family business. So a nice $3.5 billion, I think that was it, probably payout for them today. So Romaine, pretty good if you were a Birkenstock brother today.
Yeah, I mean, they did well, and they're walking away with their, $3 billion. I don't know how they split that up. Did they do it 50-50, or are they like regular siblings?
That's a great
and
question.
They're just going to squabble over it for the next, 5 years. In all seriousness, though, we talk about the market opening up, meaning, and because this isn't just about IPOs in general, this is also about a lot of those private equity and private capital companies needing an exit plan. And if there is an on-ramp there for them, or off-ramp, if you will, I guess, to come to the public markets, I mean, because let's face it, this was actually a successful IPO, meaning what they sold to their investors here and what they got. Now, the secondary trading, of course, was awful. So there's a sense here that you can still price something and price it aggressively. And I guess, like I said, if you get your money, I mean, what does it matter if it flopped, 10% on the first day?
At this point, right? Because everyone else who needed to get paid did get paid. That's a good point. I go
Are
back.
all your Birkenstocks the same color, Scarlett?
No, they're all. I have a lot of metallic Birkenstocks.
Metallic?
Yeah.
Cool.
I have silver
They're
ones.
fancy.
I have like a bronze one, a pewter one.
A pewter or pewter?
Yeah, pewter.
Oh, pewter.
Yeah.
Oh.
Sneakers. I have a lot of sneakers.
I just wanted to point out, I know we're looking ahead to CPI for tomorrow morning, but I wanted to point out again, tomorrow's actually the anniversary of the one-year low for the S&P 500 bottom. So in that span, it's up about 22%. So that's something else I'm keeping my eye on.
Why do you keep? You brought this up before. Is it?
Yes,
is this,
I brought it up last
and it sounds
week.
ominous every time you bring it up.
It's not. It shouldn't be ominous. I'm just saying, hey, it's been 1 year.
Okay, I don't know. I don't know if you wanted to make a call.
Oh boy, I'm not going to make a call on the stock market here, but I'm just probably thinking about, like we'd said, there are a lot of other companies that are looking to how this IPO did and if they're going to come out next. I mean, I think a lot of us probably like those leggings, Bory, from the athletic wear maker. What are they going to do next? We've got Game Change Solar maybe waiting in the wings. So who knows? They might be a little nervous to test the waters after this one.
Yeah, I like those Bories. They're really comfortable.
Real nice.
Yeah, they're soft. Yeah. All right, that does it for our cross-platform coverage of the market close on Bloomberg Television, radio, and YouTube. And a reminder that Bloomberg Business Week is now on Bloomberg Originals. We'll be back tomorrow at the same time, same place. And coming up here on Bloomberg Television, don't go anywhere. A sit down with an NHL legend, Mark Messier, going to be joining us for an exclusive conversation. He has a new venture called Game 7, and I'm told he's going to tell us all about it. All that more coming up in just a bit. This is Bloomberg. Welcome back to The Close. The focus right now on the consumer and the challenges facing the food sector. Let's get some insights out of David Marberger. He's the Executive Vice President and Chief Financial Officer over at Conagra, which of course has dozens and dozens of well-known brands, including Healthy Choice, Duncan Hines, I like that one, and Bird's Eye. A lot to talk about here, Dave. And I want to just start off here with what you're seeing in terms of buying trends. I mean, there's been a lot of talk that certain pockets of the consumer space are under stress right now, and a lot of people are trying to trade down to slightly cheaper products. Are you seeing that in your line of business, in your brands?
Yes, we had our first quarter earnings last week, and as part of our earnings, we had very strong margin improvement, profit improvement. Our cash flow was strong, but our sales were flat. And what we saw is a lot of categories, not just at Conagra, but really in categories across food, volumes have been down the last 13 weeks and even longer. Volumes down 5, 6, 7% versus prior year. And what we're seeing in our data and our research is that consumer balance sheets are stretched. So we're seeing this behavior where consumers are selectively splurging. They're deciding to travel and to treat themselves. But on the other side, they're watching their spending. They're cutting certain grocery spend. In our case, we're big in frozen foods, as you just mentioned. We're big in both single-serve meals and multi-serve. So we're seeing better performance in multi-serve, where you can feed more people, and we're seeing more volume declines in our single-serve. And again, we believe that's temporary because the consumer is stretching their balance sheet and trying to make their money go further.
I am curious. I mean, you've been in this, you've been with Conagra for years, and before that, some other food companies for at least a couple of decades here. When you look at past economic cycles where we did see the consumer retrench just a little bit, are the parallels that we're seeing now, are they comparable, or is, I guess, what's unfolding right now markedly different?
It's a great question. If you look historically, food companies like Conagra usually do well in what I'll call recessionary type environments where people need to watch their spending. You'll see historically people will eat out less and they'll eat at home more, and that plays well for us, obviously, as a food manufacturer. What is a little different right now versus historically when you're in a recession or approaching a recession is unemployment's very low. So labor is strong. So consumers are stretched. Inflation has gone up on everything that you buy, but jobs are available. So people are working. So it makes it a little bit different than maybe some of the historical trends that we would see in our business. But we still believe that as we go forward and consumers continue to be stretched, they're going to look for ways for their dollar to go further. And eating at home is one clear way to get more bang for your buck as opposed to going out to dinner as frequently.
Eating at home and also trading down to private label packaged foods as well, which is gaining market share, certainly as consumers trade down. Which segment of your business is most resistant to that trade down to private labels? Would it be snacking versus staples versus frozen foods?
Yes, snacking is resistant, and our frozen business, actually, we have low indexing of private label in frozen. So, we're a scale player in frozen. It takes a lot of invested capital to be successful in the frozen business. So over time, we just haven't seen as much private label concentration in frozen and our snacking business.
So I guess the question, Dave, is how do you stabilize volume sales in the near term while this is all happening? And as a follow-up, at what point would Conagra consider reducing prices to improve the volume trend?
Yeah, and first, and we talked about this on our call last week, is we're going to increase our investment. So if you look at the merchandising investment and the promotion, when you're in the grocery store, when you see products on display, merchandised, and price deals, we're doing that at a much lower level than we were a year ago. And part of the reason is because supply chains were strained last year, so supply wasn't as consistent. So you don't want to promote and try to sell more volume when you can't supply. So our supply chain is much more normalized now. We're in great situation with our inventory. So we are going to increase our merchandising investment going forward. We're also going to increase our advertising and promotion investment. We're going to concentrate that mostly on our frozen business and our snacking business, which are really our growth platform. So frozen, we have Bird's Eye, Marie Callender, and then in our snacking business, we have Slim Jim, Orville Redenbacher. These are great brands that we really believe are going to respond favorably to more merchandising and advertising investment.
Yeah, and then, of course, you guys had that great deal with WWE on the Slim Jim, which just as a former wrestling fan, I would just say very clever, by the way. Dave, I do want to get your thoughts about the cost of some of the food ingredients that you need to make a lot of these products here. There's been a lot of volatility when it comes to agriculture prices over the last couple of years, from the pandemic to the Ukraine war, as well as other factors here. Are you seeing a little bit more stabilization in some of those costs?
Yeah, we are. We updated our guidance for a fiscal year, which ends May of 2024. We estimate our inflation all in, which is our materials, our labor, overhead, everything, to be about 3%. But you have to keep that in context. Over the last 3 fiscal years, our inflation is a little bit over 30%. So if you think about in the food industry, historically, inflation's been in that, call it 2.5%. And over 3 years, we're seeing 30%. So we're seeing 12 years worth of inflation in the last 3 years. And so clearly the rate is moderating, but we still have inflation. We're not seeing deflation across the board. We have certain categories where we are seeing prices come down, but we see other categories like tomatoes and beef where prices are going up. So 3% is our overall estimated average for this fiscal year.
Final question to you, Dave. Conagra stock yields about 5.12%, which 2 years ago would have been fantastic, except these days there are plenty of alternatives for yield. What kinds of assurances are you able to give on dividend growth?
Yeah, free cash flow is a big priority for us. If you looked in the first quarter, we delivered free cash flow of $300 million in the quarter, which is normally a quarter when we're not generating as much free cash flow because we're building our inventories. That's a free cash flow conversion almost of 95%. So cash flow is our priority. The last 2 years, it's been more difficult because we were rebuilding our inventory levels given the impacts we had from COVID. So food companies do really well with generating cash flow, and Conagra's no different. So we feel really good about our cash flow forecasts, our projections. It's a priority for me. It's a priority for the board and generating cash flow to pay down debt and to provide attractive returns to our shareholders. And at a yield of over 5%, that's a pretty attractive investment.
Dave Marberger, really appreciate your joining us. Dave is Executive Vice President and Chief Financial Officer at Conagra. All right, coming up, game on. Former New York Rangers star Mark Messier is all about stepping up when the stakes are the highest and achieving success. The Hockey Hall of Famer is here now to tell us about his new venture called Game 7. This is Bloomberg.
We met up. Nice to meet you again. Right here. Good to see you. Nice to see you too, Mark. Yeah, nice to meet you. Yeah, good to see you again. Yeah.
See you again? Great. Actually, you guys.
Okay. Oh, okay. I'm going to move this over here.
15. 10 out. All right. So score 10.
We turn now to the business of sports. It is the start of a new hockey season when every team theoretically has a shot at making a championship run. But actually winning it all, that is a different story, one that our next guest knows all too well. He is Mark Messier, one of the greatest hockey players of all time, and he's here exclusively to tell us about his new venture called Game 7, along with his co-founder, Matt Vlasic. Welcome to Bloomberg, guys.
Great to be here with you. Thank you for having us.
Mark, I have to start with you because I want you to set the scene for us a little bit here. Tell us briefly what Game 7, the idea of it, means to you, because on the ice, it's really a do-or-die moment when your back is up against the wall.
Well, I was incredibly grateful for the experience I had as a National Hockey League player, and not only for the teammates that I played with, but also for the experiences that I've blended well into retirement. For me, gratitude. I was so grateful for the experiences that I had as a player, the winning championships, the effort required, the discipline that it took, the team concept that was always prevalent trying to your point, win a championship. It's not easy. It's not for everybody. But those learnings have sustained me well into retirement. And when I think about my past experiences, it just reminded me that there's a reason why people are successful. There's a reason why people do great things in the most pressurized moments. And Game 7 is really based on trying to teach and help people learn those experiences, and so they themselves can ask them, what is my Game 7 moment and how I react when I'm faced with it.
Okay, that leads us perfectly to Matt. How does Game 7 form the basis then of this new business that you're starting?
Yeah, so what we're doing here is Game 7 is an innovative performance lifestyle platform, underscoring the journey to success. We will come to life through content, community experiences, and ultimately consumer products. And look, our mission is to help inspire and equip you, me, to achieve our Game 7 moments. Not all of us can do what Mark has done, but if we listen to his stories and other athletes like himself who have achieved the unconquerable, have won in those unparalleled moments, 7 of 9 Game 7s.
Yeah.
There's so much for us to learn.
Oh, so you're saying you named it Game 7. That wasn't a coincidence, right? I am curious. Give us a sense here, though, of what people can expect when you get the full launch up here. It's obviously not just going to be Mark talking into a microphone. There's going to be a lot of other stuff going on as well, right?
Yes, for sure. As I mentioned, there's a whole slew of content, and we will come back to talk more about it. It'll debut in 2024. There will be experiences. We will rally our community around Game 7, and ultimately there will be products that will help equip you to achieve those moments.
And of course, Matt, this new venture has a number of other co-founders aside from Mark, Messier, and yourself. You've also got Danny DeVito, Isaac Chera. Your investors include Chris Mullen, Tommy Hilfiger, Jeannie Buss, of course, daughter of Jerry Buss. Tell us a little bit about how this all came together.
Well, interestingly, Mark and Ike were approached by a small company who had registered some trademarks to Game 7, and in the deck was a picture of Mark, and they said, this is amazing, we don't want to invest, we want to own. And so we had a grand vision of what we could do with Game 7 and how important it was to Mark's career and many other athletes' career. And then the team that we reached out to, and the names that you mentioned, and there are even more, all resonated with it. Even a guy like Danny DeVito has his own Game 7 moment, and he talks about when he interviewed or read for Taxi and walked in and threw the script down on the ground and said, "Who wrote this stuff?" And that was his Game 7 moment. It could have gone either way. It was do or die. He put it all on the line and achieved his Game 7 moment.
So, Mark, I got to ask you, because you're beloved to New Yorkers for what you achieved, not in Game 7, but in Game 6, when you basically promised that the Rangers would win Game 6 and then move on to Game 7 and move forward to the finals. Talk about the importance of the mental preparation that you need to do before a Game 7 moment.
Yeah, I think it really gets down to trust, not only trusting your teammates, but trusting yourself. You put the work in, you put all the effort into all the way leading up into those moments there. And you have to have an unwavering belief in yourself. Nobody can hand out 5-gallon buckets of confidence. The confidence comes from the effort and the discipline and the things that you put into your craft. For me, it was hockey. And so when you're faced with those kinds of moments on those critical times, you get into a deep sense of relaxation because you know you've put the work in. You've done it 1,000 or more times in your lifetime. And it's really about just executing on those moments there, or forgetting about the what ifs, the outcomes. Just play the game and stay in the moment. It's easier said than done, obviously, because I've failed many times myself and suffered many heartbreaks throughout my career. That was very disappointing. But overall, there's a way that to success, and I think that's what, for me, is one of the most important things about starting this Game 7 brand, is that I can hopefully inspire many boys and girls to not only chase their dreams, but give them the tools required to be successful.
What's the end game, though, when we talk about building out the business here? I mean, what exactly do you hope to maybe see at this business when maybe potentially you're long gone?
Well, that's a great question. We think we can branch outside of sports into the Game 7 realm. As we're talking about, what's your Game 7 moment? Everybody's had a Game 7 moment in their life, I can guarantee you. And what happened in those moments? How did you internalize that? What was the effect of it on you? Did you make the right decision? Were you successful, or did you fail? And if you did fail, what happened after that? Did you keep climbing? Did you keep trying? Did you get back up and keep swinging, so to speak? So I think for us, the aspirational brand is super important to us, and we think we can do that to many people, not only young and old.
Mark, one final question about Connor Bedard, who, of course, is the generational talent.
The hot topic right now.
The hot topic.
It's amazing.
Is he going to get to a Game 7 with Romaine's Chicago Blackhawks?
I would assume he's going to play in many Game 7s throughout his career. He was amazing last night. And to think about the pressure that young man has had on him since early age, and then come into National Hockey League, get drafted first overall, all the expectations and a storied franchise coming in there like he did last night and having the game that he did and winning the first game ever in the National Hockey League was incredible to watch, actually. And how many 18-year-olds have that kind of composure to go into that kind of environment and do what he did last night?
Mark, it was great to have you here in
Great
studio.
to be here with you.
Mark Messier, along with Matt Vlasic, the co-founders there of Game 7. Stick with us. We'll be back in a moment. This is Bloomberg. Romaine Bostick here with a look at how markets performed here on this Wednesday afternoon. You saw green on the screen for most of the major indices, with the Dow, the S&P, as well as the NASDAQ all moving higher for a fourth straight day. The Russell 2000, which had been on a 5-day win streak, that win streak was brought to a halt today, though it only fell marginally on the day, down by about 0.1%. You did see the VIX get tamped down. You did see the dollar get tamped down as well, and you saw a big pullback once again in the crude oil space, with WTI now back below $84 a barrel. Though you did see that haven bid come in to the yen, to the dollar, and of course into treasuries, as a lot of people still concerned here about the big unresolved issue going on in the Middle East.
All right, let's get some insight right now into the health of the live events sector. We're joined now by Stan Chia. He is CEO of Vivid Seats, and Stan joins us from the NASDAQ, where he is celebrating the second anniversary of Vivid Seats listing. Stan, great to see you.
Great to see you too, Scarlett. Thank you for having me.
So I noticed that you raised your full year guidance for a second time, so clearly business is good, and it seems like everyone was attending live events this summer. I know Romaine went to see Beyonce. There was also Taylor Swift. Can you give us a glimpse into what demand looks like right now and in the coming months as inflation continues to bite and expenses like student loan repayments start to come in?
Yeah, sure. Look, I mean, live events, I think consumers continue to show a lot of resiliency in the category. You know, I myself just enjoyed Guns N' Roses and Austin City Limits and the Foo Fighters there. Just, I think live events, again, are booming. And what we've continued to see, I think, is continued resilience and strength in the category. I think, as you mentioned, in our last quarter, despite adding over $1 billion in GOV from last year, we're guiding to still double-digit growth on the top line, as well as double-digit growth on the bottom line. And so I think we continue to see that strength in the category so far this year.
Well, what sort of, I understand that so much of the attention this summer was obviously on Taylor Swift and Beyonce for obvious reasons. But when we talk about the long-term health of this sector, it's really kind of the acts that are maybe a tier or two below them that kind of sustain things, because those are the folks that we're going to see repeatedly, and quite frankly, that we can actually afford to see repeatedly, Stan. What do you think, though, becomes like the next big driver? I mean, is there anything on the horizon that you're looking to where you say, okay, this is going to be a big catalyst for us?
I think the catalyst is in the category, where, again, as we've seen it across both the up-and-coming, Gen Zs who I think are coming into purchasing power and what they're deciding to prioritize their spend on, and we see that prioritization on live events and experiences. And then, I almost refer to myself these days as a geriatric millennial, and I'm also prioritizing my spend on live events. So as you look at that slate, and we look at the amazing acts that are coming to market, you're certainly seeing the strength in the concert area. You're seeing comedians and theater with a lot of strength as well. And then when you look at sports, which generally has been fixed with the big four leagues, you're starting to see, I think, new things come into the category as well, with a combination of, F1 being a category that we're watching. We're seeing women's sports, Also, I think earlier this year we saw, the WNBA finals, hitting really, really large numbers, or even women's gymnastics, as Simone Biles, as she's made her run through, we're certainly seeing strength in all of those. So I think across the board, I'd say it's really strength in the category, and consumers continue to prioritize this over other discretionary ones.
That may be the case, Dan, but let's talk about what sport fandom looks like. Emory University, which I know you got your MBA at, has data that show Gen Z just really isn't that into sports. Only 23% of Gen Z are avid sports fans, 27% are anti-sports, a huge contrast to older generations. This is clearly an existential challenge to pro sports leagues. From where you sit, Stan, are there signs that we could be at peak live sports events and maybe approaching an inflection point?
Yeah, like certainly from what we see, we continue to see across all the categories that there's a lot of strength here. You know, I think there was conversation probably in 2021 around, hey, is what we're seeing just pent-up demand, and is that coming to a head? And certainly where we sit now in October of 2024, I think we're certainly past the pent-up demand period, and what we at least at Vivid Seats are seeing across all the categories, be it sports, concert, comedy, or theater, is that we are still seeing that strength across all of them.
There was a lot of discussion last year about some of the antitrust issues or the perception of antitrust issues in this space, obviously not focused on your company. But I am curious as to whether that was ever truly resolved. There's still been a lot of chatter that regulators here in Washington are still looking at ways to maybe, I guess, diversify the industry, for lack of a better word. Is that something that you're having conversations with your folks?
Yeah, I think, look, how we look at the space has always been oriented around our principles of, I think, fair competition, transparency to users, and then continuing to invest in value, for example, whether it's our, award-winning customer service or loyalty program. Yeah. And I think as we continue to see what's happening on the legislative front, we are certainly very supportive of legislation that would support the principles that we fundamentally believe in.
Stan, great to catch up with you. Stan Chia there, the CEO of Vivid Seats. We want to go down now to Washington, where the President of the United States is holding a roundtable with Jewish community leaders in the wake of that horrific attacks in Israel over the weekend. Let's take a listen.
Around the world, quite frankly, discussing what's going on in Israel. And I want you to know that I want to thank you as well for, all of you as well, for working the work you're doing to bring comfort and in this moment of grief for those who are grieving as well. And you'll read this weekend in synagogue, the Torah teaches us that God made stars to, quote, give light on the earth and separate light from darkness. Give light on the earth and separate light from darkness. It's been hard to find that light during the darkness of these past few days. When terrorist groups like Hamas brought not only terror, but sheer evil to the world, evil that echoes the worst and matches, in some cases exceeds the worst atrocities of ISIS. More than 1,000 civilians slaughtered in Israel. By the way, I've been speaking with a number of Israeli leaders, a number of leaders around the world, leaders in the region as well. And, among those who have been victimized, this evil, who've been killed, are at least 22 American citizens. This attack was a campaign of pure cruelty, not just hate, but pure cruelty against the Jewish people. And I would argue it's the deadliest day for Jews since the Holocaust. The deadliest day since the Holocaust. One of the worst chapters in human history that reminded us all that expression I learned from my dad early on, silence is complicity. Silence is complicity. It really is. And I want you to know, I think you've already figured it out, I refuse to be silent. I know you refuse to be silent as well. I know you're here with my senior staff. You all represent a voice that America has to hear. America can't be silent. We not only reject terrorism, but it goes beyond that. It goes beyond rejecting terrorism. I spoke with Prime Minister Netanyahu for I don't know how many times, but again this morning. And already we're We're surging additional military assistance to the Israeli Defense Force, including ammunition, interceptors to replenish the Iron Dome, and we've moved the U.S. carrier fleet to the Eastern Mediterranean, and we're sending more fighter jets there in that region, and made it clear to the Iranians, be careful. We want to make it real clear. We're working on every aspect of the hostage crisis in Israel, including deploying experts to advise and assist with recovery efforts. Now, the press is going to shout to me, and many of you are, that, you know, what are you doing to get these folks home? If I told you, I wouldn't be able to get them home. Folks, there's a lot we're doing. A lot we're doing. I have not given up hope on bringing these folks home. But the idea that I'm going to stand here before you and tell you what I'm doing is bizarre. So I hope you understand how bizarre I think it would be to try to answer that question. In the days ahead, we're going to continue to work closely with our partners in Israel and around the world to ensure Israel has what it needs to defend its citizens, its cities, and to respond to these attacks. As I said yesterday, my commitment to Israel's security and the safety of the Jewish people is unshakable. The United States has Israel's back, and I have yours as well, both at home and abroad. You know, you can see the pain in some of your faces. I walked into this room. You okay, kiddo? Well, your fear for family, friends back in Israel. You worry about kids being targeted in school, about going about their daily lives. You hurt by the downplaying of Hamas's atrocities and blaming Israel. This is unconscionable. And I've asked members of my team, including Homeland Security Secretary Mayorkas and Attorney General Garland, to work intensively with our Jewish community partners so many of you here to set up security around Jewish life in America, identify, prevent, and disrupt emerging threats that occur. You know, we're also going to continue to condemn and combat anti-Semitism at every single turn, at every turn. You know, the past few days have been a solemn reminder that hate never goes away. Hold on a second, I used to think you could defeat hate, that you could make it, all it does is go underground. It just goes underground, it doesn't go away. It only hides until it's given a little oxygen, a little bit of oxygen. And that's why I've secured the largest ever increase in funding for physical security for nonprofits, including synagogues, Jewish community centers, Jewish day schools. And in May, we released the first ever national strategy to counter anti-Semitism with the input from many of you in this room. Many of you in this room helped write that. It's the most ambitious, comprehensive effort to combat anti-Semitism in American history, in all of American history. And we're aggressively implementing it. But we must all do our part and forcefully speak out against anti-Semitism and push back against the attempts to deny or distort the facts. To make clear, there is no place for hate in America. Not against Jews, not against Muslims, not against anybody. And we mourn the act you and so many leaders have across the country, showing us what thousands of years of Jewish history has shown us. The enduring strength, and I mean this sincerely, the enduring strength and spirit of the Jewish community. If you excuse a point of personal privilege, you should say in the Senate. That's why I took my kids, everyone when they turned 14 years old, one at a time, put them on a plane and took them to Dachau. I wanted them to see that you could not know what was going on walking through those gates. You could not fail to understand as a country what was going on. And that's a fact. It had a profound impact on my children and my grandchildren. Some thought taking a 14-year-old grandchild was not a mistake, but I took them one at a time. I got 3 more to go. And folks, it's important. You know, the miracle of Israel is Israel. It's Israel itself. The hope it inspires. The light it represents to the world. And folks, I was asked in one of my very frank conversations with Bibi and with Herzog, so why do I feel so deeply about this? It's not about the region. I truly believe Were there no Israel, no Jew in the world would be ultimately safe. It's the only ultimate guarantee. The only ultimate guarantee. The only ultimate guarantee. And folks, because of you, and I mean it sincerely, because you're speaking up, because of the intensity and the intellect and the brilliance you bring to this cause, I think we have a chance to end this in a way that makes it very difficult for it to be repeated. I want to thank you for your leadership. And as I said, there's a lot to talk about. And but I'm really, quite frankly, concerned as to, it's hard to talk about this without detail. And it's contrary to our interests to let out the detail of what we're going on. I mean, this is just round the clock, as you understand. You fully understand. But, you know, I've known Bibi for over 40 years. In a very frank relationship. I know him well. And the one thing that I did say, that it is really important that Israel, with all the anger, frustration, and just, I don't know how to explain it, that exists, is that they operate by the rules of war. The rules of war. And there are rules of war. And I believe Israel is doing everything in its power to pull the country together, stay on the same page, and we're going to do everything in our power to make sure Israel succeed, and God willing, to bring home those Americans who are in harm's way. I'm going to let you all have the private conversation you've been having, which you should continue to have.
You are listening to an impassioned President Biden give remarks. He's addressing Jewish community leaders right now, condemning, of course, the deadly attacks on Israel by Hamas over the weekend. If you want to continue to follow his remarks, you can check it out on the terminal at LiveGo. And of course, the discourse surrounding the Israel-Hamas war is proving fairly difficult to address at colleges and universities, as students as well as administrators grapple with the complex and divisive nature of the war. Bloomberg's Janet Lauren, who covers higher education, is here now with some more context. And we saw this happen at Harvard, and we're seeing this happen right now at University of Pennsylvania.
Well, it's a difficult issue, and at Harvard, what happened was student groups came out very early, and they blamed this on Israel. And there was no response immediately from the leadership at Harvard for several days to condemn that. And former President Larry Summers came out very divisively and said that is wrong. This was an attack that needed to be, atrocities needed to be condemned. And the Harvard leadership did finally come out with a very divisive statement, but in the meanwhile, things fester, and that was our story. You're seeing something similar at Penn. The question is, what is the answer to dealing with free speech on campus, which has always been complicated, and hopefully our guest here today, our Princeton president, Chris Eisgruber, can also give us some insight onto that.
All right, well, let's bring Chris into this conversation. Chris Eisgruber joining us right now. He is the president of Princeton University. And Chris, I'll just pick up where Janet left off there. I mean, colleges, I guess by default, are supposed to be kind of these bastions of free speech. But as I'm sure you know, when you have competing views, differences of opinion, sometimes extreme differences of opinion, how do you navigate that?
So we have to keep two principles in mind at all time. One of them is that our supporting free speech is one of our foremost obligations as a university, and you want engaged disagreement about topics that matter. You hope that that disagreement will be civil. You hope that it will be scholarly and informed. Do you know that sometimes when you have students reacting in the moment and off the cuff, they are going to say things that they may regret later and that don't reflect the institution's position, but you have to be protecting free speech. The second thing you have to do is look for ways to speak up for the values of the community in ways that are consistent with the obligation to protects free speech. So I and every other university president will face questions about whether or not we're going to put out a statement on a particular incident or event around the world. In general, we're going to be cautious about doing that, but most of us have spoken out about this particular issue.
But do you think it's harder to do that in this particular environment where it just seems a little bit more politically charged, not just on the issue of Israel and Palestine, but on a lot of other issues, culture war issues here in the country as well?
It's a super hard thing to do on lots of different issues for exactly the reasons that you raise. Universities should be places where there are students from many different backgrounds and where there are many different viewpoints represented both on the faculty and in the student body. When you start talking about the alumni and more broadly, lots of different constituencies. And as you say, right now we have wide polarization around those issues. Different people are going to hear messages very differently.
What's the mood like on campus right now?
Well, there's a lot of anguish and anger, obviously, over the murderous attacks that Hamas made in Israel. But at Princeton, at least, the discourse right now is civil. People are asking themselves what their obligations are, but also supporting one another during this period.
I ask because you are a scholar of religious freedom. You've testified this several times. Does Princeton play a role in guiding or moderating the dialogue, the conversations taking place?
We do that in a variety of ways, right? Part of what we do is try to model for our students at all times what it is that we want from scholarly exchange. At Princeton right now, when we have freshmen who are coming on campus, one of the modules in their orientation is a module around free speech that is not just about the need to respect free speech principles, but also the importance of having civil dialogue about issues that matter. We expect all of our faculty members to be promoting this in their classrooms, and some of our faculty members are writing in a scholarly way about what it means to protect civil dialogue, what academic freedom means, and what free speech is.
I don't envy your job, or really the job of any university president right now, because in addition to whatever we're going through right now in this debate, there's also been, of course, a lot of other, if you will, criticisms of the way colleges and universities have gone about, whether it's with their admission processes, trying to create a more diverse campus, as well as other issues here. Is there a sense here that when you see the pushback, like let's just take the Supreme Court ruling on affirmative action, and really just the multi-decade drumbeat to try to sort of do away with some of these programs here, how do you still remain steadfast to your ethics, your ethos, and your mission to create a more diverse campus when now you have something that is enshrined in law that says be careful how you trade?
Yeah. Let me just say one thing before I get to that, which is I feel like you should envy me and other university presidents, because the jobs are hard, but there are all these issues. But what we get to do is spend time with the most extraordinary scholars and some of the most extraordinary young people in the world and help them to flourish. But part of doing that is sustaining the diversity that makes our campuses so vibrant. And one of the things I firmly believe, and that we believe at Princeton, is that in order to be excellent, we have to be drawing talent from every sector of society. So the recent decision out of the Supreme Court changes the tools that we have available to do that. The Supreme Court has said that you can't make selections on the basis of race alone, or even race as one particular factor in a decision-making process right now, but you can take it into account when you're looking at how a particular individual's experiences may have been shaped by their identity, racial or otherwise, or about how it is that their contributions to the community might be shaped. So we've worked under a lot of these restrictions in the past as we've tried to diversify and had some success at diversifying our faculty. We have trained our admissions team to make sure they comply with the law, to do things differently, but to continue to push for excellence and diversity.
Yeah, in the meantime, it sounds like it's a very careful evaluation of every application. And of course, schools like Princeton get so many more applications than they have spots for. At some point, that flood of applications comes at a cost to the school. How do you cope with the increase in this flood of applications? Do you hire more admissions officers? Do you rely on AI in any way?
we don't rely on AI. We do hire more admissions officers. We think it's important to read carefully and to read in a way consistent with our institutional values and the law. The other thing we're doing is expanding the undergraduate student body, right? So
by how much?
We are undergoing a 10% expansion right now that will add 500 students to what was a 5,200 person student body. And our board of trustees has said once we finish that expansion, we should be ready to expand again, including through a transfer program. So one of the things that we've added is a program that takes community college transfers and military veterans, and we're going to continue to grow that over time.
I am curious about some of the concern here about the cost of a college degree, and more importantly, the payoff of that college degree once you get into the workforce. As I'm sure you know, there's a certain generation that has really kind of reevaluated that prospect of whether they or their parents want to spend $100,000 or whatever it is these days to do that here. I mean, how do you respond to that in terms of the value proposition to go to a school like Princeton or any other school for that matter that could potentially set them in debt for several years?
Yeah. I think a college education at a very wide range of colleges and universities is one of the best one of the best investments that people will make over the course of their lifetime, taking into account the cost and taking into account foregone income. Mm-hmm. There's a great study out of the New York Federal Reserve that documents this, and they continue to update it. The exact numbers vary. What's really important is that people focus on this as an investment, and they focus on completing the degree, right? If you complete an undergraduate degree at a respectable college or university, including mine, but including a wide range of others, you're going to get earning power afterwards that allows you to pay back those debts. But completion is essential to that.
Yeah, I got to ask you about legacy consideration. Wesleyan joined Amherst and Johns Hopkins in removing legacy consideration for admissions. How are you thinking through that? Are Princeton alumni engaging with the school about this?
We have a Board of Trustees committee, and we've announced this publicly, that is looking at what we call admission priorities, which would include things like legacy preference. What I will say generally is that at Princeton University, our bond with our alumni is a great strength of the university. It allows us to do things like expand the student body in the way that we were just discussing, while also increasing financial aid to students and making sure they have the same opportunities as their predecessors. Our expansion will create more seats than all of the seats that we give to our legacy students as we go through this initial expansion and then a second one. So part of what we're asking, right, is all right, what's the best way for us to continue forward on a mission that depends on sustaining those bonds with our alumni and sustaining diversity at the university?
Really appreciate you coming. This was a great conversation and something I think is close to all of our hearts here on the set.
Thank you. I appreciate the opportunity.
Yeah, neither one of us went to Princeton. I went to a little known school called Northwestern. I think, Scarlett, you managed to squeak into Cornell, right? Yeah. Okay.
Fantastic places.
And fantastic university out there in New Jersey. This is the president of Princeton University, Christopher Eisgruber. Really appreciate you taking time to be with us today here, Scarlet Fu, on the close. It was a pretty varied day here where I think the market's really still trying to sort out everything that's going on with the economy and, of course, a lot of geopolitical issues as well.
Next up tomorrow is CPI, whether that sets any direction for the Fed and for the markets.
Stick around. Balance of Power is coming up next. They're going to have all the latest on the race for the House speakership, as well as an update on the U.S. response to the Israel response to the attacks over the weekend. This is Bloomberg.